Good morning, everyone. I am so delighted to have you join me and the equities team for our first virtual summit, Investment Strategies under a Trump Administration, where you will hear from 10 of our experts who will discuss potential policy changes, what segments or sectors they may impact, and what it means to your own personal investment portfolio. Good morning, I'm Paula De Laurentiis. I'm the CEO of Equities.com. We're a financial media platform focused on megatrends in the impact space. We're positioned to gauge next-gen and women investors and the financial advisors who serve them as the investment landscape shifts into the so-called Great Transfer of Wealth era. With that, I'd like to introduce you to Thomas Ku, the head of ESG strategy at Morningstar Indexes. Thomas is an experienced leader with over 30 years in sustainable investing and is a pioneer in ESG indexing. Good morning, Tom.
Good morning, Paul. Thank you very much for this opportunity to join the summit today. A little background on myself. I've had the privilege of working in sustainable investment for the past 3 decades at KLD Research and Analytics, RiskMetrics Group, MSCI, True Value Labs, and now Morningstar. My focus, as Paula suggested, has been on creating benchmarks to enable ESG investors to implement a wide range of innovative investment strategies. And it's afforded me a seat at the table with many of the world's leading asset managers and asset owners, and provided insights into what motivates them to think differently about investment. So I hope today that my remarks can set the table for the sessions that follow on the program today. Well, we've convened here against the backdrop of a seismic policy change in the U.S. And I think the question I want to address today is how can we respond as investors? So I'm going to focus on how Trump's fiscal policy may affect the macroeconomic environment and also drill down into climate policy, which is an issue on the minds of many ESG investors. So first, a couple of definitions. On ESG, sustainability is defined as meeting the needs of the present without compromising the ability of future generations to meet their own needs. And ESG itself is an analytical framework to identify risks and opportunities associated with systemic risks and economic externalities related to environmental, social, and governance factors. So it's looking at issues like worker relations, employee health and safety, supply chain management, customer privacy and data security, energy management, and so on. It boils down to basically 3 principles: materiality, a long-term perspective on risk, and transparency. And so ESG analysis informs sustainable investment decisions by addressing material risks and opportunities over a long time horizon. And what differentiates sustainable investing is taking account of the impact of investment decisions, knowing that they have real-world implications. So I think it's fair to say that we ignore at our peril both the impacts on our investments and of them coming from ESG issues. So Morningstar provides research and tools to empower investors to make more informed decisions. And recently, our CEO, Kunal Kapoor, articulated his position on ESG and materiality. And he defined materiality basically as being about risk, value, and impact. In other words, fundamental financial considerations. So as we know, materiality for a company centers on factors that affect its financial performance, and information is material for an investor if it could affect their investment decisions. So while the principle of ESG materiality, I think, is well established, it's also worth noting that not all ESG issues are material, and they're not necessarily good measures of risk for all material ESG issues. When it comes to transparency, I think one of the likely casualties of a Trump administration is the SEC climate disclosure rule for corporations. In the face of opposition, SEC Chairman Gensler paused the rule when Biden was president. Now I think it's unlikely to see the light of day for years. The good news is that multinational companies doing business in Europe, whether they're from the US or not, are already subject to more comprehensive disclosure rules. So for better or for worse, European regulations stand as de facto global standards for this kind of disclosure. When it comes to ESG today, we can think about it both in terms of carrots and sticks. Not unlike the stock market, interest in ESG investing has sort of ebbed and flowed over the years, but it's progressed over time, and it will continue to. Today, there are $3 trillion in assets under management in sustainable funds globally. 84% of that is in the EU, about 11% in the US, so big disparity there. But institutional AUM is about 10 times that, so probably somewhere in the vicinity of $30 to $35 trillion. The difference between the US and Europe, I think, is largely attributable to cultural differences and attitudes toward regulation. Europe really has an institutional consensus that favors sustainability, and since 2015 has relied on regulation to guide activity. So the EU taxonomy, the Sustainable Finance Disclosure Regulation, or SFDR, the Corporate Sustainability Reporting Directive, CSRD, for those of you who are keeping up with the acronyms, they're all examples of regulatory efforts in the EU designed to drive sustainable corporate and investment behavior. But by contrast, the US, of course, relies on a more market-based approach, avoiding regulation wherever possible and relying on carrots rather than sticks to generate beneficial market outcomes. The, I think, somewhat misnamed Inflation Reduction Act is a good example. I'm not sure what it has to do with reducing inflation, but it's a good example of using tax incentives, rebates, and subsidies to achieve desired objectives in terms of bringing about more investment in a green economy. Of course, one of the consequences of this approach is that the US is more susceptible to the kinds of policy swings we're about to experience when administrations change. And I think climate policy is a case in point. But before we get there, I first want to turn my attention to economic policy under Trump, particularly his fiscal policies with regard to taxes and spending. The highlights of his proposed tax policies include extending the 2017 tax cuts, which primarily benefited the most wealthy, bringing back the deduction for state and local taxes, reducing the corporate tax rate for domestic companies, exempting various kinds of incomes from income taxation, and of course, tariffs. A 20% tariff on all imports plus an additional 50% tariff on imports from China is what he has proposed. It's pretty clear that tax cuts reduce federal revenues. So the Trump strategy is to reduce spending, read Elon Musk and Vivek Ramaswamy, and offset revenue losses from tax cuts through economic growth and import tariffs. But we really have to be clear here about tariffs. They're not, contrary to Trump's claim that they're paid by countries, they're paid by individuals. And tariffs have a place in economic policy, either for industrial policy, trade negotiations, or potentially for revenue enhancements. But they may work as a negotiating ploy if trading partners fold, but it's understood across the economics profession that nobody wins a trade war. I went to some analysis from the Nonpartisan Tax Foundation that estimates that Trump's proposed tariffs and partial retaliation from trading partners would together offset more than 2/3 of the long-run economic benefit of his proposed tax cuts. And then they go on to say, and this is a quote, in general, Trump has proposed tax cuts that provide a larger relative benefit to higher income taxpayers, while his major proposed offset of higher import tariffs falls harder on lower and middle income taxpayers. In other words, if enacted, the likely outcome from these tax policies will be higher deficits, higher interest rates, lower growth, and greater wealth inequality. These factors would all have a negative impact on aggregate demand in the economy. I want to turn my attention now to climate policy and focus on three facts. First, it's hard to fight physics. Second, the global economy is decarbonizing as we speak. And third, businesses hate uncertainty and value stable policy regimes. With regard to physics, the science is clear that carbon dioxide from burning fossil fuels has accelerated climate change, but it's happening faster than even most scientists predicted. Addressing it requires achieving an equilibrium between how much carbon dioxide goes into the atmosphere and how much is withdrawn by a combination of natural processes like photosynthesis and other natural carbon sinks, and technological means like carbon capture and storage, for example. It doesn't imply that there's no role for fossil fuels, just that there is only room for a significantly reduced one. The effects of climate change are becoming increasingly evident in everyday life. Hurricanes and other extreme weather events, flooding, wildfires, drought, and all of these have potential implications for systemic disruption, for example, interruptions in food production or climate-induced migration. The global economy, according to what most scientists say, is way behind its carbon reduction goals. And so the urgency is greater now than ever. The good news in this context is that the global economy is decarbonizing. The decarbonization is part of really a secular transformation in response to climate change. And today, for example, renewable energy is cost competitive with energy generated by fossil fuels like coal and natural gas. Solar is today at 6 cents a kilowatt hour, wind at 4 cents a kilowatt hour, versus coal at 15 cents and natural gas at 5 cents. And the important thing here is not just that it's cost competitive, but in the past decade, the cost of solar has fallen 90%, the cost of onshore wind by 70%, and the cost of batteries by more than 90%. And they'll continue to fall. The price of natural gas, in comparison, fluctuates with the market. So supply and demand factors are going to drive the price of natural gas up and down, but it's not going to consistently fall the way we expect it to with renewable resources. Coal, for example, produced less than 20% of US power in 2022. And that was down from 53% in 1997. So 25 years earlier, in over 25 years, it fell significantly. It's simply increasingly uneconomic. And so the point is that cost is an important factor driving toward renewable energy. And these market forces are in play independent of most policies that the US government can put into effect. The last point I want to make in this context is that businesses hate uncertainty and they value stable policy regimes when it comes to making long-lived investment decisions. Trump intends to withdraw the U.S. from its participation in the Paris Accords, as he did during his first administration. He also has said he'd like to loosen restrictions on fossil fuel interests to enable coal, gas, and oil extraction to increase, even though the U.S. is the largest producer of fossil fuels in the world. He also wants to free up fossil fuel companies from regulations on methane emissions. And this is important because methane is the most carbon intensive greenhouse gas, 20 times more carbon intensive, for example, than natural gas. And it's a byproduct of natural gas exploration. A lot of companies, even oil and gas companies, are on board with managing methane emissions better. I'm going to read a quote here. I don't think the challenge or the need to address global emissions is going to go away. Anything that happens in the short term would just make the longer term that much more challenging. I've been advising that we have some level of consistency. That's a quote from Darren Woods, the CEO of Exxon. That was unthinkable even just a few years ago. And that was a quote from last week arguing against the Trump administration's proposed withdrawal from the Paris Accords. Companies understand the economy is changing and want an investment environment within which they can proceed in that direction. So what are the implications for investors? I think it's a truism that there'll be winners and losers as the economy decarbonizes. Every company and every industry will be affected, whether it's an easy to abate industry or a hard to abate industry like cement or aluminum, for example. For investors, of course, it's always a challenge to pick winners and losers. But there are two types of climate-related investments for investors to consider, what I call climate transition investments and climate solutions investments. Climate transition investments focus on companies taking steps to transform their business models to operate profitably in a low-carbon economy. Now, most companies are early stage in this endeavor, but companies like Morningstar Sustainalytics are developing forward-looking metrics that enable investors to identify which companies are progressing on this pathway and which are not. So there is increasingly data available to help make these kinds of decisions. Climate transition funds typically offer broad, diversified portfolios that are designed to track the market closely, so they can serve as core holdings from an asset allocation perspective. In this context, I would say that engagement practices can influence corporate behavior. So investors should seek funds whose engagement and proxy voting policies reinforce their investment objective. By contrast, climate solutions funds invest in companies providing technology, products, or services that support the mitigation of or adaptation to climate change. So, for example, green infrastructure, electrifying transport, battery storage, smart grids, energy efficiency, renewable energy, smart water, clean tech, et cetera. In other words, there's a whole range of areas in which new and innovative technologies are going to be what defines the future economy. So climate solutions are typically an investment opportunity based on this fundamental transformation of the economy. And their portfolios often include small and mid-cap companies. So as a result, they're typically less diversified and more volatile than broad market funds like the climate transition funds. And they would serve as a satellite investment in an asset allocation strategy. So there are going to be great opportunities for investors who are climate aware and thinking about how to take advantage of the transformation that's already underway. Of course, I'd be remiss if I didn't say a couple of words on AI. The first thing I want to observe is that AI is extremely energy intensive. Many of the leading tech firms know that, obviously, and are seeking clean energy to power their AI operations. And this is important because many of them have also made net zero pledges. And at the same time as they are committed to reducing their carbon emissions between now and 2050, they're driving their energy use up based on their AI operations. And so, I think AI at the same time will be instrumental in achieving the carbon transition and will be an engine for innovation, right? But there is some concern that the sort of gold rush going on around artificial intelligence might crowd out venture capital and private equity investment in climate solutions. And so this is something to keep an eye on. I think it's worth observing that private markets are really incubating many of the companies and technologies that will provide needed solutions, though many such companies, will be out of reach for smaller investors. It's just worth paying very careful attention to where the innovation is going to come from. So, in closing, I'd like to just, recognize that the unprecedented political polarization in the US comes at a time when we need effective policy coordination at a global level. So that's a tough ask under the best of circumstances, and it's going to be made tougher by many of the expected, I'll say proposed, if not expected, changes coming in the Trump administration. I've provided my perspective on what we might see from the new administration. I don't share most of their economic and climate policy objectives, and I haven't even alluded to the likely effort they'll make to outlaw ESG investing practices. That could be a whole other topic of conversation here. I certainly don't have a crystal ball, and that's one of the reasons I'm an index investor rather than a stock picker. But I think it's also important to recognize that there are countervailing forces at work politically and in the markets, and I've tried to point out where some of those are. ESG analysis evolved to help investors address long-term systemic risks and opportunities. And this has led to the development of new kinds of data to inform better investment decisions. So as a result, retail, wealth, and institutional investors have tools at their disposal and can play a critical role in financing and supporting the climate transition. Hopefully, the combination of attentive investors, market forces, and regulatory initiatives will blunt the efforts of the Trump administration to sidetrack the climate transition. So I hope this provides some useful context to learn from the speakers who follow. I'm very interested in hearing from them, and I want to thank you very much for your time and attention.
Thank you, Tom. We do have a couple of questions here, and I was hoping that maybe if you have a minute or two, we can go through them. One is not related to the administration. It's a question regarding your index, and if you can shed some light on the rationale of including McDonald's in your SRI index.
Well, I think it would depend which index it is, but fundamentally, one of the sort of critical elements of indexes is that they are rules-based. And the way we build our ESG and sustainability indexes at Morningstar is using data from Sustainalytics. And so depending on which index we're talking about there, the kinds of issues we're looking at are related to ESG risk and opportunity, but also controversies companies might be involved in, and so on and so forth. So I'm actually not in a position to comment on a particular company, though I think I understand that the impetus for the question is whether or not a company like McDonald's is provides sort of sustainable and healthy food. And that's a question that I would have to defer to the analysts at Sustainalytics.
Well, thank you. Thank you very much. I think that's it for this morning. Is there anything other than what you shared that I'm sure there isn't, but I think that we just want to say thank you very much. We appreciate your time. I thought it was fascinating. I loved your discussion around AI. That's always something that's on the top of my list personally. And it's exciting to see how it's driving innovation in the energy sector. So thank you for sharing that. And we'll move on to Jeff Gitterman. So thank you. Hey, Jeff, how are you?
Great, Paula. How are you?
I'm great.
Thanks for having me.
I want to introduce Jeff Gitterman to our session this morning. Jeff and I are good friends. I met him back in 2018. One of the kindest and biggest supporters I've ever met. You can find Jeff on equities.com. We have every single one of his videos from fintech.tv on equities.com. We transcribe them and we summarize them for our readers if they don't have time to see that video. Jeff is the partner of Gitterman Wealth Management and the CEO of Gitterman Asset Management. Welcome, Jeff.
Thank you so much, Paula. Thanks for the kind intro. I appreciate it. Very excited for today.
Yes, me too. So we're going to bring your panelists on.
Awesome.
I just don't know where they are, so let's see.
Yeah, he said it'll take a minute as they get loaded in one at a time.
Oh, so
there's one.
So was I just doing that in the green room?
No, we were live, but they weren't in yet. Yeah, there they are. Got them all.
Okay. Great.
All right. I think we're waiting for one more. Perfect. There we go. Hi, and welcome to our equities.com webinar. I'm certainly excited today to host this panel. I was very thankful for Paula and equities.com for letting me put together this panel because it speaks right to the heart of what a lot of our investment themes at Gitterman Asset Management are. So I'm really excited to talk today. We have been focused on these themes for a while, water for a very long time, but certainly grid infrastructure and uranium through nuclear as well for the past year or two. And we work with all three of these folks, and I'm certainly really happy to have them on the panel and dig into this topic today. I think one of the questions that we get asked a lot lately is, okay, what's going to change now since we've been in these themes for, certainly over a year or sometimes as long as 10 or 15 years. What might change now under current administration? And we'll certainly tackle that as well. But first, I'm going to let the panel introduce themselves and talk a little bit about what their company does. So we'll start with Ron.
Hi. Well, first of all, Jeff, thanks for having us. It's great to be on a equities.com webinar. I'll just give you a really quick background on myself and then jump into Clean Edge and keep it pretty brief. I've gone through 3 technology waves. I've always been interested in sort of which technologies were going to be the most disruptive at any given time. So when I graduated university, I worked in telecom as it was being deregulated in the late 80s. I then worked in the internet throughout the 90s. And then really had always wanted to work in clean energy, clean technology, which is something that we sort of helped popularize that term. But to work in that space wasn't really till about 2000 that it was ready for prime time. And so in 2000, with Joel McCower, I started Clean Edge, which is my firm. And that firm really focused for many years on convening. We put on big conferences and events. We did a lot of webinars. We wrote reports. I co-authored 2 books. We did everything we could to help NGOs, government agencies, and corporates navigate the clean tech landscape. Amongst all of that, we launched stock indexes because we were already benchmarking the space. And so we did our first index with NASDAQ on US listed clean energy in 2006. 2009, well ahead of the curve on the grid space, we launched our smart grid and grid infrastructure index. And today we also have a water index. We just launched a global water index. So we have a US water and a global water. We have global wind. We kind of cover all of the energy transition and the infrastructure markets related to water and grid. So let me just tell you, we're going to talk about grid mostly today. We got other experts to talk about water and other areas. We'll focus on grid. I just want to give you a quick lay of the land of why grid is so important. A modernized grid is the backbone of the electrification trends that we're seeing right now. There is no way to do it without the network. And so that backbone is what we're going to talk about today. It's what was the theme that we put together now back in 2009. And it's really changing, real quick shifts, going from centralized to nodal. So it's starting to look more like the internet with microgrids and VPPs or virtual power plants and communication layers. It's going from one direction to bidirectional. That means I'm not only consuming energy, but I am serving up energy or helping the grid when it's stressed, or having energy storage to help me when the grid is challenged. And the business model is going from consumer to prosumer. And finally, we'll talk a lot about this today, huge shift from conventional fossil fuel energy sources to solar storage, wind, and clean energy, as well as some nuclear. So that's what we'll be talking about. And again, thanks for having us. I look forward to the conversation.
Thanks, Ron. John, I'll pass it over to you.
Yeah, thanks. Thanks everybody for participating in today's webcast. I'm John Champaglia. I'm the CEO of Sprott Asset Management. I'm based in Toronto. Our firm's been around since the early 80s. We're best known for being a boutique money manager that focuses on metals and mining. We're very unique in that we are a small manager that runs around 30 billion of assets, but we're also publicly traded on the New York Stock Exchange. So we have a lot of transparency around what we do, and we do a lot of novel things that most asset managers don't want to get involved in. We run very large physical commodity funds that cover gold, silver, platinum, palladium. We have the world's largest uranium fund, believe it or not. We also have a physical copper fund. And we also run a whole suite of either index-based ETF strategies that focus on critical materials and mining, as well as a number of active strategies. And today, I'm here to talk about nuclear energy's role within the climate-focused transition and energy transition. And as I reflect on it, we started talking about this in 2021. And I very vividly remember at COP26, and right now COP29 is going on in Azerbaijan. And when advocates and participants from the nuclear energy industry participated at COP26, you can imagine some people lost their minds. And fast forward to today, and you've now got over 20 nations pledging a tripling of nuclear power by 2050. So sentiment has changed enormously. Energy policy around the world has shifted tremendously, and that is giving an incredible tailwind to the uranium industry as well as the whole nuclear fuel supply chain. I spend most of my time doing educational presentations to institutional investors that are looking at this space for the first time. In many cases, in 10 or 12 years, the sector was pretty much left for dead. Governments didn't really care about it with the exception of a few places in the world. And now we've seen a real hard shift back to the technology for a whole bunch of, I think, of very science-based reasons that we'll get into in the presentation.
Awesome. Thank you, John. Mark, Robert.
Yeah, good morning, and thank you again for inviting us to participate. I'm with a group called Water Asset Management. We've been investing exclusively in water since 2005. One of my partners has been investing in water, physical water, since the early 90s. So I came to Water Asset Management after working in capital markets for 20 years. And one of the things that attracted to me was, water is a very interesting investment asset class. Not only is there lots of demand and it's poorly understood, but it is capital intensive. It is largely a series of discrete markets where supply and demand are captive, and very difficult to move water large distances to take advantage of pricing inefficiency or pricing differences. And generally, it's been an area where, from a financial point of view, there's been huge underinvestment. There's a large capital spending need just to replace what we've already got or repair what we've already got in the ground, not even talking about what we have to do ahead of us in terms of getting water to communities that have no access to water or sanitation. But also we're seeing increasing demands for water from lots of power development, increased housing demands, increased water quality needs. So you have what we find is an industry which is fairly economically insensitive, that is absolutely essential, that has very limited competition. Nobody's going to rip up a street to put in a competing water pipe or sewage pipe to take advantage of a market opportunity, and it creates impact. So from us, it's kind of the trifecta. The other thing that's interesting is that you have historically been able to outperform most market indices by investing in water in companies that are well managed, well capitalized, and serving a very, very necessary and difficult to replace need. So for us, it's very compelling. It continues to be compelling, and I think the new administration is going to create some more compelling reasons to continue to invest in water.
Awesome. Thank you, Mark. So we're going to touch on climate change, but it's not going to be the overarching theme of the presentation. But first, I always like to set the stage on climate change because there's certainly a lot of differences and discrepancies and disagreements out in the world of the investment markets and capital markets about climate change. So I just stay very down the middle. What we know for a fact is that it's been getting warmer lately. You can argue about how long that's going to last or about how long that's been going on for, but we know for a fact it's been getting warmer lately. And what we know from science is that for every 1 degree temperature that it gets warmer, it can hold about the atmosphere can hold about 7% more water. And that's cumulative. So for every degree Fahrenheit, not Celsius, warmer that we get, the atmosphere sucks more water out of the ground, which means we tend to have more droughts and more drier soil, more risk of fires. And then, unfortunately, it dumps that rain unlike it has in the past. Instead of doing it over a year, you might get the same amount of rain the next year, but get it all at once rather than spread out over a year. For those of you that are listening in from the Northeast today, we're having the longest drought in the Northeast that we've seen, I think, historically, maybe for as long as we've been record keeping. Really no rain in October. We're already in the middle of November, and no rain in November. And we're dealing with forest fires on a daily basis. Over 537 burning in New Jersey and New York right now. So the world is changing from a risk-based standpoint. And what I'd like to pose, and we'll give each speaker a chance to respond to this, is how is that changing hydrological cycle that we're dealing with impacting the investments that you're making and the need for the investments that you're making? And I'm going to actually start with Ron. since water is at the center of my dialogue, we'll finish with Mark on this conversation, but I'm going to start with Ron on this one.
Sure. Well, thanks. Well, certainly there's no room for climate denialism. And Jeff, in my view, it's science-based reality that we're facing huge climate disruption. That said, at Clean Edge, we've always seen climate as one of many drivers. We didn't get into the clean tech space with climate being our main driver. It was really a whole host. We actually had the 6 C's in our first book, which included climate, cost, China. There were a whole bunch of drivers. Today, if I look at the spaces that we track, in particular, let's focus on grid and energy transition, both. It's the declining costs, it's the pure economics that are driving the shift. So we'll talk a lot about that over the next 45 minutes or so, whatever we have here. I think that if I look at the other key drivers very quickly, climate is one of them. That's resulting actually in investments. So we see much more money for the last 8 years. More money has been invested in energy transition than fossil fuels for the last 8 years. This year, energy transition investments will be at their highest level ever. So that's one thing. The other area for us is aging infrastructure. We have in place grid infrastructure, water infrastructure that's been around for decades, sometimes 50 years or more. So the need to replace that infrastructure is critical. We're seeing load growth unlike any time in history right now with this. We'll talk about that a lot today, but computational demand, onshoring, all the stuff that's happening. So there's this huge need for grid infrastructure to meet all that load growth. We're seeing 3 times more renewables that will likely be deployed by 2030 from the last COP. Now, we may only get to 2.5 times, but it's a lot of more renewables coming online. And then we have these learning curves I talked about, where solar and storage are now the cheapest forms of energy on the planet. Solar is the cheapest electricity on the planet. So I think that climate, obviously, anyone who's interested in this space looks at climate. We were concerned about clean air, clean water. Our name is Clean Edge. That was important to us, but it's all these other drivers that are really just as important. And I would add one last thing, just for anyone as an indexer, we've never been an ESG indexer. We are a positive screening indexer. We have an index in Europe that tracks our grid index. It's a UCITS. So it's a fund that tracks our index. They ran an ESG screen against our work, a Sustainalytics screen. One company came out. So I think our positive screening says a lot about how we view the world. So I'll just wrap by saying we're looking for innovation. We're looking for where the progress points are. And in our case, that serves this market well. So yeah, I'll leave it at that. But climate is obviously something that's critical and important, but not our main driver.
Thanks, Ron. I think from our perspective, I got into sustainable investing because of a concern about climate change and mostly a concern about physical impact risk of climate change. And I've been focused on that for the past 10 years. And while there's been a lot of debate, to your point, ESG is really an outward-looking in data set. It looks at how things going on in the world from a social or environmental or governance standpoint might impact the companies you're investing with. It's not a great climate change screen because it's not telling you a lot about the companies you're investing in and their impact on the world outside or their
a lot
supply
of
chain
companies
risks
clear
and other
ESG
things.
screens that would never make it into our indexes.
Exactly. Yeah. So it's something that we've always been conscious of. John, I'll pass it over to you. Same question.
Yeah, I mean, when we originally got involved in uranium, it was simply about a structural supply deficit, which was a byproduct of an industry that was largely put on care and maintenance as the world kind of shifted away from the technology after, the earthquake and tsunami in Japan in 2011. And we just thought to ourselves, look, you've got a power source that produces 10% of global electricity, 20% of US electricity, and at some point you're going to run out of inventories of the stuff and the price needs to reset. We weren't thinking about climate. We weren't thinking about energy transition. At that time, it was a simple supply and demand imbalance that our thesis was, you either resuscitate the industry or the lights go out for 1 in 5 households in the United States. That obviously has evolved enormously over the last 3 years. I think it was COP27 where the nuclear industry finally got a seat at the table. And that's when governments around the world started to publicly acknowledge they had no way of hitting their net zero targets if they proceeded with plans that had been in the works for many years to close down and decommission the existing fleet of nuclear reactors that they had operating. And unlike countries like China that keep building 4 to 6 new reactors every year, many countries in Western Europe, United States, and Canada were basically letting their reactors just kind of slip away into retirement. And I think I think that the best case study or data point I can share with you was in California back in 2023 when the government there did a massive flip-flop on closing Diablo Canyon, which was the last nuclear power station in the state of California. There's nothing wrong with the power plant. It had been in the works for years to close it down in 2025. And in 2023, the governor did a flip-flop because they finally admitted if they closed it down, the state would be subject to greater risk of brownouts. And that's just because you've got incredible demands growing on the grid for electricity. Think about, we're talking about heat and water. Think about air conditioning. One of the biggest drivers of grid growth is actually air conditioning as the world gets hotter. And think about air conditioning in places like India. As a middle class forms there, you're talking about millions of people that want air conditioners. This is all creating grid growth. This is all creating a lot of demand on critical minerals that basically form the backbone of energy generation, transmission, and storage. And so the thesis has really evolved to a structural supply deficit, to growing demand to meet net carbon neutrality goals. Obviously, baseload power is becoming very, very important. And I think there are some challenges in some regions in the world that not all energy forms work. Land use issues are real in terms of the land footprint, in terms of some of these competing technologies. So it's not a one-size-fits-all solution. I think every part of the world has different endowments of energy and resources that it needs to leverage to meet its energy needs. And we've always been advocates that nuclear is part of the mix. It is the perfect complement to renewable energy. As Ron said, the prices of solar panels have absolutely collapsed around the world. And the deployment of solar around the world is just mind-boggling right now. And we would continue to think that will happen given the cost curve on the technology. But again, you're still dealing with a variable power source, and this is where baseload power comes in as a nice complement.
Awesome. Thanks, John. Mark, I'm going to hand it over to you, but before I do, I'd just like to really bring up what's been going on with some of the storms we've been seeing enter off the coast. So when we look at something like Helene, which traveled all the way up into the mountains in Asheville, and the rain, as we've just spoken about before, really got hung up there and just dumped an enormous amount of water in a short period of time. And what's interesting is they had, over the last storm, buried their water pipes 15 feet below ground to make sure that if another storm came along, like the one that they had gotten hit with back in 18, I think it was, they'd be okay. And as we know, those pipes all got washed away in this current storm. So I'm wondering, when we have been thinking about water, there's lots of ways to think about it. But for our perspective, it was always around the physical risk of the infrastructure as these storms get worse, as heat impacts piping more than it has in the past in places like Arizona. And I'm wondering if you could include any kind of comments on that in your talk right now. Thank you.
Yeah, I mean, obviously, when we first started the business and back in the, early 2000s, we couldn't even use the word or the phrase climate change. People would throw us out of the office. It was like, doesn't exist. So we talk about climate variability. And, ultimately, water is really at that forefront, as Jeff has pointed out. It's either too much, too little. and we're not necessarily prepared for it. The infrastructure side, you know, stormwater and preparing for storm events it's a third rail issue because they're unpredictable. They require a huge amount of capital to be deployed well in advance of the event actually happening. And it's in areas where, you know, may or may not have been historically, you know, relevant. So it is going to become a big factor going forward. I think you're already seeing the insurance markets as a transmission, you know, device of risk. You know, large parts of this country are now becoming uninsurable. And whether it's for fire, whether it's for flood, whether it's going to be for these extreme weather events, whether it be tornadoes or so, it's the transmission is real and the risk is real. And I think it goes to the point that we like to make is I think the early stage of climate investing, a lot of it was about mitigation. I'm going to continue to do my thing over here, but I can buy something over there that's going to make it okay. You know, it's going to compensate for this bad activity. Well, we're well beyond that. Now we're into adaptation, and you know, a lot of these places are going to have to adapt, and it's unfortunately not a cheap prospect. The other thing that we don't focus enough about is, you know, even in the North Carolina debacle, their wastewater treatment plants got taken out. So not only the physical infrastructure, but the water system itself, the water quality. As we know, the focus on water quality was never, you know, it was always assumed your water was drinkable, and it really was kind of external events that happen every once in a while. But now it's not a foregone conclusion that your water is safe. And so this idea that you're going to have to invest more and you're going to have to rely on systems which are properly treating your water for all the, you know, whether it's PFAS, whether it's heavy metals, whether it's, you know, antibiotics, whether it's pharmaceutical products, there are an increasing number of risks to water quality, which we can add to the infrastructure. So look, the good thing is these problems are solvable, and they will require more physical spending. And I think the value of water as an input to one's daily existence has been underappreciated for a long time, and you're going to have to pay more for it. But when you think about water bills, they're still relatively affordable compared to cable, internet, other things, which, quite frankly, you know, you can find cheaper alternatives too, or you can live without. But water, you can't live without. But I would focus on adaptation, and most of the systems in the world, most of the water systems that exist today are owned by governments or local government entities. And at times, they have been preoccupied with other capital spending needs. And it's not because they're ill-intentioned, but sometimes they've been distracted. And so we've seen a lot of forestalling of necessary CapEx that, quite frankly, is coming to haunt us in various places, but all solvable, and provides for, you know, what we think is a robust investment opportunity. And then the energy demand, you know, we're talking about energy demand and the fact that solar has gotten cheap. Solar is, you know, quite frankly, we are seeing an explosion of demand. We own, in our other part of our business, we own private assets in water. We own a lot of physical agriculture with water rights in the West. We're seeing an explosion in demand for land with access to water for the siting of power, both traditional and sort of newer forms of power. So a lot of people have thought of power demand increasing, but not a lot of people have thought of the corresponding water demand that goes with it.
Awesome, thank you. Again, for those that don't know, at Gitterman Asset, we've really had a focus on climate, and our focus has been historically on the physical risk of climate, so not the really transition risk of climate. We looked at this problem about 10 years ago and really decided that a lot of countries and the political will to transition away from traditional energy sources was just not there, and therefore physical risk would exacerbate, and these hydrological cycles would speed up in their amount of variability. And what we didn't foresee, which is really one of the main reasons for this particular panel today, is how this little known thing at the time called AI would basically throw, gasoline on an already burning fire. We traditionally have had about 2% energy growth demand. We are looking at numbers from most of the big energy associations at somewhere between 6 and 10%, depending on who you talk about, energy demand increases going forward. That means building of data centers and all of these things that really impact you using AI. I think the average person doesn't even understand every time they use ChatGPT on their phone, how much water they're actually using. There's a big disconnect in this world between something we do on our phones and the ultimate environmental impact of that. So I'm going to start this time with John, because obviously we've seen this explosion in nuclear take place over energy demand issues, and AI is really right now at the center of those issues. And maybe you can talk to how that's impacting, as we've seen lately, every tech company coming out with a nuclear deal, it seems, weekly.
Yeah, and as you said, I mean, we would have never have foreseen that playing out, and it's really happening very quickly. And it does feel like a bit of a domino effect as more and more big tech companies are announcing different arrangements. But maybe I think it's important to take a step back and, from the US perspective, if you look at load growth over different cycles, we had periods of huge load growth after World War II. In the last 20 odd years, it's been very nominal. And that's just because, we've outsourced a lot of industries to lower cost jurisdictions in the world. And thank God for engineers that make things more energy efficient. So load growth has been very nominal. If you listen to the analyst calls from major utilities over the last 2 years, they're all saying the same thing. Their customers are asking for more electricity. And that's for a number of reasons. It's not just AI data centers, as somebody mentioned at the beginning of the call. There's a massive reshoring going on that was really a response to COVID and the invasion of Ukraine, where a number of critical industries ranging from semiconductors, pharmaceuticals, defense industries, clean energy technologies, electric vehicles, et cetera, they're all being reshored back to the US to diversify away from aggressive nations. That is creating a lot of demand on the grid. But for AI specifically, just some little facts. Today, it's estimated about 2% of our electricity demand is used for data centers in the United States. The numbers that are forecast in 2030 are somewhere between 7 and 10%. And the reason is the data centers are evolving from traditional, storage in the cloud, doing a Google search, to basically a data center. An AI data center is essentially a supercomputer, and a supercomputer is using enormous amounts of electricity. Goldman Sachs estimates that a AI data center query can be up to 10 times as much electricity intensive as a traditional data center query. So the big tech companies are in a global race to win this AI with other countries and regions in the world. They are realizing that a key obstacle to winning this race is securing power. And it's not just power they need. They want clean, firm power. And they are doing deals with renewable energy companies at a very large scale. And more recently, they've announced a flurry of deals related to nuclear energy, everything from funding the restart of a nuclear power station that's been closed for 5 years, 3 Mile Island Unit Number 1, as well as financing power purchase agreements or doing equity investments in companies that are developing new technologies, which are often called small advanced modular reactors. And these are the perfect, I think, use case for these data centers that are very energy intense. The other thing that's got the tech companies excited is this idea about co-location. And what that basically refers to is, instead of getting entangled in the web and the legal battles around building high voltage transmission lines in the United States, why not build the nuclear power capacity next to data centers, or building the data centers next to existing nuclear power stations, which Amazon recently announced just a few months ago with Talon Energy in Pennsylvania. So what this is really happening is signaling energy addition. I think that's the right term. given the growing load factor. It's also, I think, bringing much needed capital to a sector that's been starved of capital for a long time. I think it's also helping to validate the technology. And big tech companies are obviously highly disruptive and innovative, and that's exactly what they're prepared to assist with, this disruption of new innovative technologies through these smaller modular reactors. And it's really building, I think, awareness to the category. And I can tell you that when I started talking about this theme to people 3 years ago, I would get the most simple questions like, are we sure nuclear energy is safe? What about the waste? Now those questions are gone. Now people are trying to figure out how this can really complement the deployment of renewables, which has expanded exponentially, how this could provide baseload power. And again, nuclear power has 0 greenhouse gas emissions, which is why the tech companies are focused on this, because they all have self-imposed net zero targets. And it's really driven by their employees. I mean, you might say that they want to be in ESG indexes and whatever, maybe, but I actually think it's from within. I think a lot of their younger employees are embracing climate change. They're very concerned about it, and they want their companies they work for to become net zero. So it's a very powerful trend. It's Amazon, it's Apple, it's Oracle, Microsoft. They've all announced deals in the last 6 months, and it's really shining a spotlight on this.
Awesome. Thanks, John. I don't know who to go to next. I'm trying to think of the flow of energy, but let's go to Mark for this one, and then we'll finish up on the grid. Certainly water is a huge necessity, along with power for data centers. So maybe you can educate us a little bit on this growing demand.
Yeah, I mean, it depends on, I think sort of a lot of data centers had been initially put in places where they got special treatment for tax credits because, you know, there was an incentive. So a lot of initial locations went into areas that were, you know, probably well sourced in power, and, you know, water was less of an issue. What we have seen increasingly is data centers moving away from the sort of DC, Virginia area out to places that have, where demand is growing. So Texas, a lot of activity in Arizona. These are very, you know, sometimes water capacity constrained areas. So we're seeing, particularly in Arizona, we're seeing a tremendous amount of demand for data centers, but also for semiconductors, all of which are large consumers of water, and which, you know, quite frankly, need to have dedicated supplies. In many cases, these particularly semiconductor fabs can consume a great deal of water, similar to, you know, a small municipality. So it's driving up the need, and the other thing is that with this comes a lot of demand for housing and for you know, the ancillary support, less so for data centers, more so for semiconductor fabs. But you're seeing a lot of growth in areas which, quite frankly, are not terribly water supplied, but are very popular for some of the destinations. I think one of my other panelists talked about the inequity of distribution of power availability or transmission availability. It is certainly the case in water. We're not running out of water. We're just running out of water in places that people want to live, or, you know, cheap water. So for us, data center is a driver of economic demand. You know, it's a driver of growth of supply for us. We, you know, from an infrastructure point of view, you know, these places need to have available supplies that they can, you know, they can essentially rationalize the capital spending that they need to make to put these places in place. But it is definitely, I think a lot of people have thought through the power side, not a lot of people have thought through the water demands of these sides. And, you know, suffice it to say, a lot of that growth is happening in areas which, quite frankly, are dry.
Yeah.
You know, in theory, they should all be in, you know, if we were putting semiconductor fabs and data centers, we put them in, you know, Michigan, you know, upstate New York, Vermont, you know, places where water is less of an issue.
Thank you. Ron, certainly our investment in Grid was really on the heels of the AI trade, and how much it would impact the need for increased grid infrastructure. So maybe you can enlighten
Sure.
us about that.
Sure. Well, there's so much to unpack here. So I think first, just to kind of walk through the computational demand of AI, as John mentioned, a simple Google search versus a Chat GPT search query is about a 10x. One of you said that. That's accurate. There are some that may even use more electricity. We may see efficiencies over time, but it's much more computational demand. And most of the estimates we're looking at show that, in 2022, about 3% of total US power demand came from computational data center queries, and we're going to go up to 8 to 10% by the end of the decade. So there's no doubt that there's growth there. And just we talked about computational demand from AI centers and supercomputers and data centers, and we talked about onshoring and manufacturing, which is key. The one other thing we missed, which is critical for power consumption increase, is the electrification of both heat and transportation. So heat pumps, EVs, et cetera. So we have gone from an era, it was pointed out, of really utilities managing power use, deep efficiency. The Japanese led the charge on efficiency, and we didn't see a lot of load growth. Now we see that load growth that you talked about. So this is critically important, and that's going to drive a lot of the requirements for power. That means more investments in transmission lines, more investment in power controls, more investments in substations, more investments in smart meters, all the things that we track in grid. The other way AI is going to impact all of this is not only on the serving up the demand, but also on the supply side. So making things more intelligent. We're tracking a lot of AI usage on the grid side for everything from virtual power plants that I talked about earlier, demand response programs, dynamic line rating. There's a lot of AI that you can embed in the systems themselves. So it's interesting. We cover both of those, and we get a lot of the companies. Great example would be Schneider Electric is working with NVIDIA right now to optimize data center design for their supercomputer chips. So a lot of interesting stuff that could happen utilizing AI to improve efficiencies. I want to talk about nuclear just briefly. Solar and wind represented about 83% of all new net capacity additions globally last year. That's of all the new capacity additions that utilities put in the ground, 83% came from renewables. I would agree that the variability of solar would be an issue if we didn't have energy storage. And energy storage is what you add on to, and again, we track that in grid, to deal with the variability. So I don't disagree that nuclear could play a role, but let's not forget energy storage is a critical component in making sure that the solar power, the variable power of wind, and we're seeing it already in Texas, we're seeing it in California, where this last summer, it wasn't a repeat of 2022 or 2020. They did not have rolling blackouts or brownouts. They did not have blackouts because of all the energy storage they were bringing online. To the amount of about 4 gigawatt of power being brought on onto the grid, 4,000 megawatts. So it's considerable. So I think that we take an agnostic approach. Nuclear would fit into the grid. The grid would serve up that energy. We need more substations and all that. But I don't know to what extent, like SMRs, for example, and I'd love to hear John's thoughts on this, seem to be still about 10 years out. So maybe 2040, 2050, we see a lot. We can repower and do some interesting stuff with existing power plants. I think John Ketchum, CEO of NextEra, said if every single repowering, you could do, even if it wasn't economical, you could do it. It represents about 1% of increased new demand in the US. So there could be some challenges on timelines and costs. And so we're more of a proponent of solar plus storage. That's where we really think most of the growth is going to occur.
And Ron, I'm just going to stay with you for 1 second. How do you think a new administration will impact some of this clean energy onboarding that has been happening and what the impacts might be?
Well, this is fascinating. So thanks. I don't think the grid will be negatively impacted by a Trump administration. In fact, I think the Trump administration's focus on crypto, on onshoring, not that the Biden administration wasn't doing onshoring with IRA, um, with all the computational demands that would happen through a lot of the policies that might come from the Trump administration, that would only serve the grid. Clean energy may be more constrained, but we ran some numbers in advance of this call and another webinar I'm doing later this week with some clients, and it was fascinating. Under the Trump administration, clean energy and every one of our indexes in clean energy and infrastructure, water and grid, outperformed. CLS, which tracks U.S. listed clean energy, was up 447% under the last Trump administration. Global wind was up 133%. Grid was up 128%. And HHO, our water index, was up 100%, all under the last Trump administration. Well, grid and water did pretty well under the Biden administration. This is counterintuitive, right? Cells was down 57.3% up until November. I think we ran it through November 5th. And wind was down 26%. Grid did quite well, and so did water. But my point here is that would be counterintuitive. If you look at also oil and gas, so if you look at XLE and XOP, they were up dramatically under the Biden administration. 106% for XLE year to date through the November 5th. XOP up 89.6%. How do you that's just incredible. And it was down, they were down during the Trump era. So I think we have to let ourselves understand there are forces way outside of Trump or administrations that do this. The other thing, there's been a lot of call by Trump for drill, baby, drill, right? That's his motto. We are the largest, the US today, the largest producer of gas on the planet, the largest producer of oil on the planet. We are making or producing 13 million barrels per day of crude oil in the United States, and we're now the world's largest exporter of LNG. That happened under the Biden administration and the previous administration. So there's not much more room left for drill, baby, drill. We're kind of tapping out at the high end in a constrained environment where OPEC is trying to pull back. So I don't know. I think just a wrap on that.
Thanks,
So that's
Ron.
sort of the performance. I'll wrap up, but I'll just say one last thing. States matter too.
Yeah,
And
for
so
sure.
we saw that in the last administration, California, Oregon, Washington, Massachusetts, they're already positioning themselves. So
Yeah.
I'm a little bit less concerned. And I also see that a lot of the IRA monies disproportionately went to red districts by a magnitude of 3 to 1 at least. And so that's going to be hard to roll back because that's a lot of jobs for battery manufacturing and EVs and other technologies in red districts. So
Thanks,
we'll
Ron.
see.
Yeah. Yeah. And I mean, also Texas, half of Texas's energy production over the last year was clean energy. So there you go. John, I'm going to give you a chance to respond a little bit to some of the things. And also there were some questions that keep coming up in the question box about what is going on with storage of uranium, other issues, but also, look, we're certainly in an interesting situation with Russia. What is going on with uranium production there? There's been a proponent of a Senate bill, I think it was, or a House bill, that talked about not using any Russian uranium. So just an overview on where are we at with SMRs, where are we at with the disposal of uranium? Maybe we could send it into space with Musk and he can drop the uranium off on Mars that is spent. So love your feedback on those areas.
Okay. That's a lot of topic. I could talk for about 2 hours on all that.
You got 4 minutes. So.
4 minutes. But at a high level, I agree with Ron. It's been counterintuitive. I mean, the Biden administration has been incredibly pro-nuclear as well as a lot of other clean technologies through, the bipartisan infrastructure law, the IRA, the ADVANCE Act, et cetera. And historically, Republican administrations have been incredibly pro-nuclear. And the reason the Biden administration has been very pro-nuclear is because of their climate focused goals. So we don't really see any wholesale changes happening with the incoming administration. I think it's all about energy addition. And energy addition is going to come from all kinds of places, including natural gas, because it is very abundant and cheap. And a lot of it we're burning because we don't know how to move it around. So I do think it's going to be all the above. Trump clearly wants to be a leader in everything. There is a bit of a fracture in the global geopolitical system that we've enjoyed since the end of the Cold War that is changing a lot of policies and specifically energy policy. So we expect more of the same. Now, will some elements of the Inflation Reduction Act get modified, caps, limits, et cetera, that may favor some things and disfavor some other things? That's very likely. These hard mandates that have been talked about in Western Europe and the United States about, no more internal combustion engine vehicles by 2035. We never thought they were even physically possible to achieve. The supply chains are just not there. China controls huge amounts of the supply chains related to EV manufacturing. And it's simple. I mean, China's a net importer of over 10 million barrels of oil a day. And one of the ways to mitigate against that risk is you shift your fleet to electric vehicles. And so they have very, national security driven and economic reasons why they're doing what they're doing. We have abundant fossil fuels, so we continue to think they're going to remain a key part of our energy systems. But the world is obviously clearly transitioning every year to more and more investments in clean. Sorry, you threw a lot at me. So what would you want me to prioritize after that?
Real quick, we only have about another minute, sorry, but storage issues around uranium, have there been dramatic changes in that? And also the timing on SMRs and some of these investments in companies like Oklo. Yeah.
So just a couple of interesting things as it relates to energy policy and geopolitics. So the US has the largest fleet of nuclear reactors in the world, even though we've built 2 in the last 30 years. China will pass the US in 2030. What's amazing to us is that the US essentially produces almost no uranium on local soil anymore. In the next year or so, that number could get to about 2 million pounds, but last year it was 300,000 pounds against current consumption of 50 million pounds per year. That hasn't been lost on current administration, or I would believe the incoming one. It's not just the production of uranium, which is a critical mineral, that is a focus. It's obviously the entire nuclear fuel supply chain, which, by the way, Russia controls huge chunks of it. And there's obviously a tit for tat set of sanctions that each country's lobbying against each other. The US has passed a law in August to ban the importation of Russian enriched uranium. In August, the Russians responded last week and said, well, we're going to withhold exports to the US. And how do you like that? And it's obviously going to pressure the uranium price, which it's starting to do. Longer term, small modular reactors. This is obviously about greater use cases. If you think about very large scale reactors, those are very ideal for powering huge metropolitan centers, given how much output they have. If you think about a data center, if you think about a remote mine location, if you think about industrial application like producing industrial heat for Dow Chemical, for example, you don't need 1,000 megawatts of power. You might need 40, you might need 100, you might need 300. And this is where the concept of small modular reactors is coming in. Everything from producing electricity at remote sites, producing electricity to replace coal-fired power stations, which there are still 300 of them in the United States, and producing industrial heat, producing hydrogen. There's a whole bunch of use cases that are being used. We're about 5 years out before the first small modular reactors are operating. There's actually 3 being built where I live in Ontario, Canada right now by Ontario Power Generation. But there are 80 different designs that are on the board for all these different applications. And they're not all going to come to market, but there's clearly capital, government, and public money that is looking to help move these technologies along, including the likes of some of the big tech companies. So it's not going to have an immediate effect, but the next 10 to 15 years, we could see hundreds of small modular and micro reactors being used, including even shipping. If you think about container ships, just like for military applications and submarines and aircraft carriers, they are run by microreactors. If you think about all the, transatlantic and trans-Pacific shipping containers. They could move away from fossil fuels to microreactors. So a lot of interesting applications that will eventually lead to more uranium demand.
Thank you. Mark, I want to, we might have to wrap up on you, but I'd love to hear from you some of the additional macro factors that are impacting water. And also, just to be clear, maybe you could give people an idea of how you invest in water, because I think it could be a little vague to people. Like, are you investing just in water utilities? Is there more variability there?
Right. So we divide the water world into upstream, midstream, and downstream. So upstream we do through private assets. We own physical water, and we can talk to you about that later. But for this audience, our public equity investments are largely tied to midstream, which is transmission, treatment, and then downstream, which is the last mile delivery, if you will, of water and wastewater services to the customer, be it industrial or residential. So it's really, that market is global, and it's an infrastructure, technology, and regulated utility mix of businesses. We happen to like the regulated utility business. They deliver water and wastewater services to everybody on this call. Some are owned by municipalities, some are owned by private corporations. We invest obviously in the private ones, which are regulated. So they have a very interesting model which allows them to earn a return on capital before they actually expend the capital. What is surprising to many people is that when we talk about the water industry, and particularly at this downstream end on the utility side, is that the vast majority of utilities in this country, in the United States, are not regulated. So they belong to cities, they belong to local governments, and they can do what they want with CapEx, either underspend, overspend, and their tariffs are not set by a regulator. They're set by the town council or some political mechanism. And that is obviously something which can be a good thing, but typically we've seen a lot of pushing back on necessary CapEx in order to fund other municipal needs. So our investment horizon for the public equity world is really tied very much to this treatment, transmission, and last mile delivery and infrastructure surrounding water and wastewater availability. So for us, the big drivers are what's happening with regulations at the state level. So the new administration probably is not going to have much of an impact on state regulation. So that's not going to change. We're driven by, demand for new housing. And we think that's probably something that it didn't matter who was in the White House. Focus on affordable housing and growing housing stock is going to be a big focus, and that's going to drive demand for us. And then obviously I mentioned all the infrastructure that is behind in some of its capital investment cycle, including water is often the most energy intensive user in a municipality. The biggest user of electricity is the water infrastructure for treating it, moving it around, and there's a lot of efficiency that can happen there.
Wow. I can't thank you guys enough. I think we really did a great job approaching some complicated issues and why the investment theme really will be maintained no matter what the current administration. To Ron's point earlier about energy and clean energy and wind, I mean, certainly under the Biden administration, there were impacts of rising interest rates and the war in Russia and Ukraine that impacted a lot of those investment themes. So, you can't really predict how certain investment themes will do under current administrations. That's really almost a fool's game. What you have to look for is long-term trends that are supported by spending. And all three of these themes, and the reason that we like them so much as an investment manager, all three of these themes have very long-term trends, both climate and AI. Neither one is going away anytime soon. And they have a lot of spend coming behind it because the IRA bill and support certainly from large tech companies. So really thank you guys a lot. Anyone that doesn't know a lot about these subject matters, they can always reach out to Gitterman Asset or directly to some of these managers as well. Thank you everyone on the panel. And I will pass it back to equities.com.
Hi there. Thank you, Jeff, Ron, Mark, and John. We appreciate your time. I found the session fascinating and incredibly informative. So thank you. The four of you have such a depth of knowledge, and you speak about it in a way that everyone can understand. So thank you very much. To our attendees, we're going to take a few-minute break. We'll be back at 12:30. In the meantime, we will be sharing some questions. Please take a look at them, and hopefully you'll answer them, and we will share the results in an upcoming email. Thank you, guys. Thank you very much.
Thank you.
Good afternoon, and thank you for continuing with us on our journey to learn how the Trump administration may impact our investments. This session is about boardroom shakeup and the implications to a social environment. So with that, I'd like to introduce Angela Atherton. She is the co-founder of Parallel Finance and an expert in gender lens investing. Hello, Angela.
Hello. Paula, we've just entered. Did you hand over to me?
I did, and I'm
Okay.
going to drop off. Thank you.
Okay, thank you.
You're welcome.
Welcome to our audience. We are thrilled to be with you here today. I'd like to give each of our panelists an opportunity to introduce themselves. So we'll start with Julie. Oh, maybe she didn't hear me. Julie, can you hear me? Can you introduce yourself for us, please?
Yes. Hi, I'm Julie Gordy. I'm the Senior Vice President for Sustainable Investing at Impacts Asset Management. What we do is invest in the transition to a more sustainable economy, and that includes all aspects of sustainability, including social ones.
Excellent, thank you. Tammy, can we hand it over to you?
Hi, I'm Tammy Haygood. I'm the founder of the Black Pearl Wealth Management Group in RBC, formerly at UBS and the Impact Investment Group. And what we do is we align our clients' portfolios with their beliefs and their desires.
Thank you. Matthew?
Good afternoon. I'm Matt Patsky, the CEO of Trillium Asset Management, and Trillium was founded in 1982 to provide for the financial needs of our clients while leveraging their capital for positive social and environmental impact in alignment with their values.
Thank you very much. So we're here today. Our panel is going to focus on exploring social movements and investing, or the S and ESG investing. And we're really looking forward to a rich discussion amongst our panelists. I think the first topic that I wanted to broach is really around diversity, equity, and inclusion, and really looking at the investing landscape post-election. It might be helpful if we just sort of start with what you all are seeing in terms of current and anticipated trends around corporate diversity, equity, and inclusion efforts. Anyone want to start for me?
I'll jump in.
Thanks, Julie.
I'm sure anyone else could too. But so what most of the corporates that we invest in seem to be doing is basically tapping the mute button. We see a lot of companies saying less about their DEI efforts, and a couple have actually said they will end DEI programs. Not many. Most of them just say we're disclosing less, but we're still doing it. And they still say that they see value in diversity efforts, and there's plenty of backup for that. I've actually published a recent paper called The Business Case for Diversity and Inclusion, which is on our website. And there's lots of evidence that including different ethnic groups, different races, different genders, different preferences, et cetera, including them in decision making really helps decision making and adds to corporate value. And most companies know that.
Yeah.
I think
sorry.
I think one thing that I've seen in talking to corporations is that they're trying to walk in the middle of the road. They're trying not to be on either side of the agenda. I guess it's a difficult time to have an opinion that might be different than others. And so I think in general, people are trying to maybe reverse engineer it a little bit and show their growth, show their productivity, and then show their DEI. So
Yeah, I would agree with the comments that were made, which is an awful lot of the effort continues. There's broad acceptance of the business case for why DEI matters, but you're walking a fine line of trying not to talk about it as much. And we're seeing some language change where they'll get to the same, they'll be talking about it for the same outcome, but they'll use different language. And so this sort of broad concept of green hushing, of trying to hide what they're working on, has been very broad-based, and we're seeing that and you'll see companies make statements about backing away from DEI, and then when you talk to them directly, they'll give you the, well, not really. They're like, yeah, but you just made a public statement that you were backing away from DEI. And so given that you committed to us that you were committed to DEI, that's a problem for our shareholders, right? But they'll be like, no, we didn't really mean it. And I'm like, yeah. Anyway, so.
well, one thing that's happening is the growth of the anti-woke investment economy, right? And so I think that people are trying to live with both sides of it. I don't think you can, but we don't have to go far. We just look in today's newspaper and find that Donald Trump Jr. is joining the board of 1789 Capital, and realize that there's not only the fight for DEI now, there's the fight almost against what they call EIG. And so it's a difficult place to be, but I think that people still see the value. Organizations still see the value.
I want to go two ways with the comments that you all have sort of made so far. Sort of, do you, based on what you're seeing, I mean, we talk about anti-woke. I was sort of hoping that had sort of died on the vine. Do we see that? How do we, anticipation, obviously, at this stage, where do we see that sort of, that piece going, the anti-woke, we're intentionally sort of challenging the DEI space at that degree, as opposed to just hoping that, putting our pressure on the corporations, but the actively investing in the opposite way? Where do you see that going?
But one of the things to bear in mind during difficult times, and I would count this as definitely being one of them, just because of the anti-ESG and anti-DEI and anti-woke stuff that's out there, is that going to get traction in the Trump administration? Yes, absolutely. They've already made that clear with some of the cabinet picks and some of the public statements that have been made. If I were in the federal workforce, I would worry a whole lot more. But it is wise to remember that there are 194 countries in the world. The U.S. is one of them. And policy is not the only driver of value in the investment world. I mean, yes, the U.S. is 25% of world GDP, but the policy can only go so far in terms of affecting what corporations do. When we look at the drivers of value in the investment world, we're still seeing things like greenness and inclusion and diversity as being value drivers, and that will stay the case. It's also wise to remember that with disclosure requirements, yeah, they can roll them back in the US. We always had horrible disclosure requirements in the US as far as ESG stuff went. Well, E and S, I should say. But we still have CSRD in Europe. We still have a lot of other countries in the world requiring disclosure of this information and still openly seeing value in being able to talk about that. So corporations that do business in the world and not just in Poughkeepsie are still seeing, the pressure for being more sustainable.
Helpful. Anyone else have any thoughts on that?
Yeah, I mean, it is globally the pressure, or I should say the direction is irrefutable. And so, and when you talk to companies, they talk about investment cycle of investing for 20, 30 years, not what the next administration's going to do in policy. And so there's not that, we're on the right side of the long-term trends, and companies, I think, acknowledge that broadly. Even the ones that are trying to backpedal in their talk about DEI acknowledge that's, that there's not going to be a reversal of trend. And we have to sort of step back and remember what went on in the last Trump administration, where we had attempts to reverse on a lot of policy issues that mattered to DEI, ESG efforts, and that was that states and municipal governments stepped up. And in the end, the changes were, yes, there were changes, yes, they were negative, and yes, that'll happen again. But there was an awful lot of opposition and a lot of if the state of California and the state of New York and a number of other more progressive states are stepping up, you're really muting the impact of the federal government changes, and I think that's what we'll see again.
So what I'm really hearing from sort of that combination of comments is that first of all, long-termism wins the day, and that would be true in fundamental analysis. That we've got a body of research that supports the value of these components being incorporated in the investment strategy. Is that a fair sort of summary of the points that you've all made so far?
I think so. I mean, we all know that these are value adds. I think it's going to be incumbent on us to show the value add and then show the causation versus the other way around going forward. I don't want to be a naysayer, but I'm not as optimistic this term around in the Trump administration. And so I think it's going to really behoove us to show the value of DEI and then show the data, if you will, of DEI.
Okay.
Yeah, just want to lean into that for a second. I like what Tammy was saying. I mean, I'm not optimistic about the Trump administration in any way from a DEI or environmental perspective. And that's partly because it's not just this administration. There's a lot more sort of rightward movement in the US economy. It was, I think, the sort of assault on corporate DEI efforts started in 2023 after the Supreme Court overturned affirmative action at college levels. I think corporations saw themselves as being the next target, and they're probably not wrong. So I don't want to make this sound like it's all, oh, it's okay, it's all unicorns and rainbows. It's not, but I think there is, as Tammy said, there is a value to this stuff. And I think it is really going to be important to show that. I know a lot of corporations believe it, and green hushing isn't going to solve any problems for them.
So while we're talking about sort of, what's actionable about this, your organizations are active as shareholder in shareholder engagement. I know in sort of communications directly with boards and leadership teams, as well as putting forward and supporting shareholder proposals. I think it might be useful to talk a little bit about where we think things are going with shareholder engagement, maybe giving some perspective of what we've seen this year and what we expect to see in the next year or so.
So in 2024, there were 335 social related proposals submitted, which is the second highest in the past decade. So interest has not waned. Over the past decade, about a third of social proposals were about DEI. So if the historical average held in 2024, that's about 110 proposals on DEI just this year. And that's like the second highest ever. In 2024, about 3/5 of all shareholder proposals were withdrawn, which is an all-time high, which means that the proponents are reaching some kind of, usually means that the proponents are reaching some kind of accommodation with the corporation and they agree to do something that's mutually acceptable. Support levels have come down. There are about 21% of all proposals that got over about a third of the votes in favor of the proposals. And that's down about 12 percentage points from the all-time high in 2021. And that's, again, I think that's a lot of green hushing. On the flip side, though, the anti-ESG proposals that are filed, they are at an all-time high by a long shot. There were over 100 of them. In 2024, there were 108 to be precise. But the average support for those was less than 2%. So what the market is saying is, we don't want to paint a target on our chest and vote for these things, but we're definitely not. The anti-ESG stuff is not passing muster.
Which is particularly interesting, Matt, I'll let you comment in a minute. It's particularly interesting because I feel like the first couple of years, investors were kind of confused and they were intentional about the language that they chose, right? So it was kind of easy to sort of, people thinking that they were supporting ESG, and that's actually the opposite of what they were doing with that proposal. Matt, sorry, go ahead.
Yeah, I would just add, I think that the reason why I think maybe we're more optimistic is the dialogue with companies. I recognize what's going on, and the green hushing, I'll just give you, I'm not going to give the name, but a large asset manager out of New York, my friend is the chief marketing officer, and they were told to take, Indeed, there's a switch in their proxy voting policy. They were told to take everything off their website that said DEI, sustainable, ESG, and he took it all down. But they're still doing it all, and plenty of their clients want it, but they don't want to piss anyone off, and they want to stay below the radar. And so you listen to what's going on and you're like, okay, that's not great because we're going to have another 4 years of them not voting their proxies properly. However, they're really there and they're very supportive, and so are a lot of their clients. And so I look at it from that lens and think, we're going to get through this. It's not going to be good. We are going to see bad policies, but we are going to make it to the other end of this, and we are going to be yes, taking some steps back and having to rebuild, but we'll make it through this. And unfortunately, yes, they're better organized this time. We know that, but let's just see how this goes in the near term. But it's like, given the people he's nominating, you do keep thinking, no, it could get crazier and it could get worse. But we're going to have to wait and see, are they effective? I mean, let's be honest, right? Matt Gaetz hasn't succeeded in doing anything as a congressman. So I don't know how that would really work if you put somebody who is anyway, I don't want to, anyway. He's obviously unqualified. We can all agree on that. But, how effective would he be in trying to, in doing damage to everything? I don't know. I'm not sure that he'd show up for work, to be honest. He doesn't do much work now.
Well, first of all, he has to get confirmed, and that is very much in question.
Yeah.
Agreed. And we have to
Sorry,
hope,
Tammy.
right? We have to hope that that's not just the only nominee they stop, but that is, anyway, Tammy, go ahead.
But I think, okay, so it is what it is, as my mom used to say, right? But I think it's also an opportunity for us to step back and rebuild and
Yep.
and refortify our data, our thesis, so that when we come out the other end, we're not trying to rely on something that or a methodology that we used 4 years ago. And so I think my optimism comes from them, being able to leave us alone because they're not going to allow us to do very much. And using that time to really go back and look at our data, the way we capture our data, the relevance of it, how do we speak about it in the investment thesis, and come out the other end with something much more robust. So that's my optimism of it.
I appreciate the optimism and I appreciate the realism. So I like both perspectives. Yeah. So stay the course, but be ready for all the things that we know are potential sort of pitfalls is sort of what I'm hearing. I wanted to grab one of the topics or subtopics that Matt sort of brought up, sort of thinking of this from sort of the investor perspective and the client reactions perspective. Maybe sort of while we're still on Tammy, what are you seeing in terms of recent client sentiments or inquiries related to the social issues in their investment portfolio?
So I think we're probably on number 2 of the stages of grief. And trying to find a way forward. And I think for my larger clients, they realize that there are other avenues out there that are not subject to the public markets that allow them to get things done. But the reality is people are forging ahead. They're putting their money where their mouths are, and they're not turning back. And I think the main reason that people don't turn back is because they believe in the thesis. They believe that we actually are better companies, better economically positioned, better users of resources by using DEI. And if you believe in that, then whoever somebody allows you to call it that or stamp it that doesn't really mean anything. But it's obviously going to be difficult in trying to comb out the people that just say, oh no, we're not talking about DEI, from those people that are not doing DEI.
What we're hearing from most of our clients is they just want to make sure that we're still doing what we do, which is to invest in the sustainable economy. And so it's kind of like, please reassure us, that you haven't, your commitment to sustainability and DEI and environmental greenness has not diminished. And we are saying enthusiastically, yes, you can count on us.
Yeah.
And I do want to come back to that, but before we talk about sort of what you all are doing in terms of asset management strategy, and I'll also come back to an element around data that data transparency that we sort of thread in our earlier conversation. So what did we learn from the last time this administration was in office in terms of what it means in terms of sort of our client concerns? What about capital flows? Again, on an earlier thread, could be an opportunity to double down. Is that what we saw in terms of behavior with the last administration, or any insights in terms of what you all are seeing in terms of capital flows into the space right now?
Yeah, I would say we're not seeing a distinct change in the immediate, like right now, but I will say it is worth looking back to 2016 and the election and the aftermath of the first Trump administration, because while we generally were in mourning and in shock the day after the 2016 election, we saw a response that ended up being the fastest growth we've ever seen in our history, as people thought about what they could do to have impact in issue areas that mattered to them, and came to the conclusion that one of the ways they could have impact was take their money out of index funds, broad market index funds, and put it to work with Tammy and Julie and, you know, firms like ours that are actually having positive impact. And so and I don't know, you know, Tammy, or Julie, what the experience was of your organizations, but I know we had really 4 incredible growth years that we ended up having to change our minimum to 2.5 times what it was, because we simply had too many incoming inquiries.
Sorry, go ahead.
And I think that that's the way we saw it going too. It was something like people feeling as if they could vote with their feet, and try to find a solution. But there was also some frustration because it wasn't clear. It wasn't what they were accustomed to. And so that's the reason I sort of recall and say, how can we make ourselves better during this period of time? Because people want transparency and want clearness. If they're going to do this, they want to know what the numbers are and how they relate to, in this case, DEI.
Now, just go back to the sort of low Earth orbit view of things. Yes, we saw huge inflows in the first Trump administration. Sustainable investing was growing really fast during that period. That was really kind of brought to a halt, like everything else in the whole world, like COVID. So in 2021, we stopped seeing these massive inflows. We stopped gaining market share. By we, I mean ESG investing. And then there was a recession, the COVID-induced recession. So there were tons of articles during the last 2 years that talked about the death of ESG and how it was gone, and support for shareholder proposals has gone down, and inflows have been reduced and so forth. That was actually true of all funds. It wasn't just ESG. So, there were a lot of people who were, recession will always put a dent in inflows into investment funds. So it isn't what we experienced basically in the last couple of years was what I think is a temporary halt, or at least a temporary pause in the expansion of the market share of sustainable investing. I expect that to change. Maybe not in the next 4 years, though.
Okay. So, I got a clear message, right? So one of the ways, and if we're thinking about actionable items for investors, one of the ways that they can show their support for this area is pull their money and direct it towards funds that they know, investments that they know are supporting these initiatives. But just maybe a question, one more question to Tammy, sort of as investors are talking to their investment managers and their advisors, how should they broach this topic? How should they express their interest in this area as they're having an investment conversation?
Well, that's a great question. And it has been the same over the 15 years or so that I've been in this industry. There are those that come directly at it and ask whether it's something that can be done. And when I first started, it was the advisors telling them, well, you don't need to worry about that, right? And as we've moved on, and almost every advisor can pull out of their bag at least one ESG solution that at least has ESG in the name, right? And so, I think that it really is important for investors to take their time and do some research on the organization, on the people that are investing. I mean, clearly I've been at UBS and now at RBC, and not every one of those, or not every one of the advisors at those organizations are committed to ESG. So you have to do a little bit more due diligence and find the individual that has been in the trenches for a while and really understands what it means and respects what it means. So I think that that's the first step that I would take as an investor, is to take the opportunity to really educate yourself on who's out there supporting you in this journey that you're going on, and who respects the journey that you're going on, and not just giving lip service to it.
And this is, Tammy, that makes a great transition. So from Julie and Matt, from a asset management perspective, it might be helpful for you to give a little bit of insight about sort of how you approach it in line with sort of Tammy's description of what we're looking for. It might be helpful for folks to know how you approach it and whether or not any of that changes in this new environment.
So we approach sustainability from the standpoint of what does it mean to be sustainable, which includes diversity. It isn't just about environment. A lot of people just see it as being green. It's not. It's very broad. So we have sort of two approaches. We have a top-down approach that rates every industry in the world, in the MSCI ACWI, to be technically correct about it, on 9 measures of sustainability-related opportunity and 8 measures of sustainability-related risk. And then we avoid the companies that are high risk, low opportunity. We also have a bottom-up process. It's called ESG 2.0. We'll probably change the name at some point, but it basically evaluates every company from just as a company compared to its peers on sustainability-related issues, everything from emissions to pollution to, green commitments, targets, to DEI numbers if we have them, to commitments that they've made there, et cetera. So it's very broad. And we haven't changed it. I mean, we change it when we get more information or when there's a reason to, when some issue arises that we didn't anticipate before, like, for example, well, AI is a huge source of opportunity in investing. It's also a huge risk because it can multiply and really sort of metastasize things like diversity and discrimination if the model was trained on the wrong data. So it can be a great boon and it can be a great risk, and we need to take account of that in our processes. But we haven't changed our commitment to the sustainable economy at all. So in terms of the sort of big picture in investing, we do expect that many of the new administration's promised policy changes will result in higher interest rates and then a much higher federal deficit, adding around $7 trillion to the federal debt over the next decade, and that's going to have a huge impact on interest rates. It remains to be seen how much of the promised crackdown on undocumented aliens will affect some service and manufacturing industries, but the ones that depend a lot on that labor force include agriculture, grounds maintenance, food service, textiles, apparel, tourism, hospitality, et cetera. We could see higher prices and more inflation in the prices that are charged in those industries as a result of if they make the crackdown effective. So we do expect changes to happen because of the policies in this administration, but our commitment to sustainability hasn't budged an inch.
I think one thing that I talk to my clients about when I'm talking about funds like Julie's and Matthew's is intentionality, because we know that the world is going to change, and we know that we're not always going to get it right, and we're going to miss some things. But if you're riding with a team that has intentionality to do it correctly, then you're okay to ride through the rough times and to ride through the unknowns. But if you look at something like AI and you're not with someone that absolutely has the intentionality to be inclusive and to be environmentally sensitive, then it's really fraught with error, right? Because the possibilities just amplify themselves. They're exponential.
Thank you. Matt?
Yeah, intentionality is really critical when you're looking at the you know, hiring an asset manager. And I'll just say Trillium's process is largely unchanged in its now 42-year history. What's changed is a lot more sources of data, because when Trillium started in 1982, it developed its own process for collecting environmental, social, and governance data because there were no data sources. Now the problem we have is there are a lot more data sources, but they are also ripe with errors. And so when you talk about the potential risks in the process of going passive with ESG data, it's that you could be introducing a lot of error in a passive product. So we just want to be careful. I'd also say that the way in which we're having intentionality about trying to have positive outcomes and impact is we're active owners, right? And certainly, you know, the Impacts and Trillium are very active owners, pressing companies for improved outcomes, which is part of the intentionality of trying to make sure that that's, you know, there's positive social and environmental impact, right, in what we do. And so that remains, and that we remain very committed to that. We have a team of 6 full-time people that focus on that, and that's you know, a differentiator of buying a passive product from one of the big players. And of course, that has been also interesting to watch. And I don't, you know, is that how have the big players responded to this backlash? And you've seen some of them respond by walking a fine line, and firms like Vanguard run the other way, right? We didn't really mean any of it, but anyway. So
Okay, so again, we're talking about making this actionable for our investors, our audience. And so what I'm hearing is we're looking for intentionality. If I'm trying to understand intentionality, some of the, and again, jump in if I'm not paraphrasing for you all well enough. If I'm looking for intentionality, looking at sort of the investment objectives and investment thesis of the organization, looking at their posture or their approach to shareholder engagement. Anything else that you'd add in terms of what we're looking for as we're kind of screening those investment vehicles and opportunities?
Well, you know, Trillium is a super engager. You know, they have those 6 people that Matt talked about. We all in the whole industry, we all depend on them. We report a lot of you look for their impact reports. If they have them, we have one. I recommend it. You know, look at what you have been trying to do and how well you have succeeded, and those measures, if they can be quantified, like how many engagements have we had? And one of the things that everybody does is they confuse engagement with companies with shareholder proposals. We engage with hundreds of companies every year. We file like 2 proposals, right? So and the engagement is all off the record. That's where you need the impact reports. You need to be able to go and see, all right, what are you talking to companies about? Like, we talked to all utilities in the S&P 500 last year about climate physical risk, and we made some discoveries that we think are really interesting. That's on our website, but it isn't going to show up in, you know, sort of bean counting things like the NPX form and so forth, which says how you voted your proxies. So I would say that the way to really understand what firms are doing in terms of intentionality and implementing the commitment to sustainability is to read their impact reporting.
Perfect. Thank you.
And as an advisor, that's what we should be doing. We should be going below the surface and adding value by really interpreting the impact statement for our clients. But I can't walk away from the fact that Matt has made this point a couple of times. You have to be an active investor. because you need to be looking at the world as it is, not the world as it was, and not the world as you would like for it to be. But you have to be in the trenches looking at the data that you currently have, looking at the environment that you currently have. And then you have to trust your, in my world, my managers, but in the general world, you have to trust your managers to look at that and make the best decision. Not the perfect decision, because that one doesn't exist, but the best decision given what we have in front of us. And I really think that that's a lesson for this time, that we cannot be perfectionists. We can't let perfection be the enemy of good. I think we have to look at what we have at hand and make the best choice versus trying to wait for the perfect choice.
So on those lines, I think we have a question from the audience that is related to this topic of active management. The question is, and I think we've partially answered it, but I want to give you all a chance to address it directly. The question is, what are your thoughts on ESG and DEI focused index funds available on the market? Are they well managed and topic focused, or are they straying from the original purpose and shutting down on visibility?
I'll just say, sorry, I was going to say the explosion we saw, as we talked about in the cycle of leading up to COVID, we've seen some rollover, and an awful lot of product that was labeled ESG has just been unlabeled ESG. There are two factors. One was the anti-ESG movement, but the more important factor was regulatory and a growing recognition that if you say you're doing something, you actually have to do it. And that was a big part of the backpedaling we saw on labeling. And so particularly with the EU and the EU regs, awful lot of product just simply basically pulled ESG from their labels. And so I just throw that out there as something that, because I've seen people say, oh, well, ESG is really on the ropes and it's down a lot in assets. And I'm like, no, it isn't. Those who are authentically doing it are still authentically doing it, and we're still in great shape. And so, you know, Impacts is doing fine, Trillium's doing fine, Boston Common is doing fine, you know, we could go on, but it's like there are a bunch of us who are doing just fine. It's a whole bunch of product that got taken off the shelf that I think people should just be, you know, not so well managed, not on topic, not really committed. The other thing I would just warn is what I already had mentioned, which is if they're just buying a database and laying it on top and then doing a passive product on a, you know, this is the MSCI lower, you know, carbon footprint index. You're kind of getting what you know, I always say to people, look what's inside it and then ask yourself, does it pass a basic common sense, the basic, you know, like, if somebody sells you a product and it says it's the world's leading ESG companies and ExxonMobil's in it, I would say you have a question mark. Now, you know, we could argue about whether ExxonMobil is one of the better integrated oil companies, but you can't tell me it's one of the best ESG plays in the world and have me not laugh. So, and, you know,
Yeah.
say that, but anyway, I'm sorry, Julie.
I'm sorry, Matt. I didn't mean to.
Take over.
So I think with index funds, you have to be really careful. There was a huge explosion. Part of that huge growth of ESG was a lot of ETFs that came on the market. And that, I think, was a lot of big investors who always regarded it as kind of a niche play. And they had a couple funds out there. And then they saw this parade passing and they sort of ran around to the front of it to sort of get ahead of it. Do they mean it? It varies. You know, there are some index funds that are actually okay and that actually do what they say they do. But the way to know that is you have to do all the hard work, which is you have to read the prospectus and look at the holdings and look and see whether they do any impacts reporting and how they vote. You know, are you really doing what you're saying, or did you just slap a label on it so that you could be the parade master? And that, I think, is where a lot of the pullback has been as well. So as Matt says, the committed are still committed and still operating. That huge growth, I think, was a lot of people just sort of, I had a friend who was standing on a street corner in New York in like 2019, and he heard someone yelling into his cell phone on the other corner saying, ESG, it's hot, get into it. You know, it's kind of, I think a lot of it was just that, you know, was people wanting to be part of this trend. Without actually changing what they do. In order to be, you know, authentic about it, you have to change what you do, or you have to actually do it. And those who've
Julie,
been doing it for a while still are. I'm sorry, Tammy.
No, I was going to be silly, and I was going to say, I thought that you were going to use New Orleans and the second line. You're just standing on the corner, the train's going by. You might as well hop in.
Yes, perfect analogy.
So I've got a couple of other questions, and actually two of them are somewhat similar in nature. And as we talk about sort of the topic of DEI in particular, the first question is, can you please discuss the income inequality or class piece of our social piece of ESG investing, and whether or not that's something that you all incorporate?
It's really tough to incorporate, not because we lack intentionality or will, we just don't have much data. We had an engagement a couple years ago, or maybe last year and the year before, so recently, where we asked companies about living wages, about paying living wages, and that varies by country. And they will always sort of say, oh, yes, of course, we pay attention to that. But then when you sort of press for data, and how do you know that? And what are you basing that on? Then sometimes things sort of turn into little disappearing vague particles that turn into nothing. So I don't think there is any reporting requirement in any country that asks for living wage data. There are a couple of countries that do require wage reporting. One is Great Britain, one is Australia. Great Britain is on the record, Australia isn't. But you can usually get the data. But unfortunately, that's, you know, companies that are either domiciled in or operating in those countries is a very small minority of the companies in the world. So it is really hard to dig down and get those data. Now, there are some companies that are notorious for paying less than a living wage. Tractor Supply was one of them. It got involved in a controversy. I don't think it's ever really gotten out of it, but you know, I think a lot of the investors that were interested in sustainability probably don't own that company. So it is something that we think about a lot. We know that it is that kind of data is much more indicative of the intentions of the company and the policies of the company than some of the data that are required. How many employees do you have? What country are they in? That kind of thing. But since it's not required reporting, and for most companies, there's probably some things that they would regard as not in their favor. And so you get the marketing spin doctors saying, nope, don't report that.
I would say that the audit around pay equity is really difficult to do. And that's not to say that it can't be done, but it's, you know, it's not in their best interest, and it's not their highest priority, and it's not easy to do, so it doesn't get done.
So I will say we do a lot of work on trying to look at living wage and supporting, for example, the right to organize. And so and did have an initiative that was successful at Starbucks to get Starbucks to recognize the right for their employees to organize. A lot of the data we're looking for is aggregated already in reports there, you know, the EEO1 to the Department of Labor. Getting companies to disclose more data is a big effort. Had we seen a second, I shouldn't say a second, had we seen a Harris administration, I do think we would have gotten finally SEC mandating disclosure of EEO1 data, which would have gotten us a step closer to there being more information and access so that we could look into, you know, gender pay gap and and have a better understanding of where people were on paying living wages. But that's not going to happen. We still have to press companies for disclosure, and the more disclosure you have, the better we are in terms of being able to get clarity of where they are. You know, let's say disclosure, despite the fact it's still bad, is improving. And it is true there are countries like the UK and Australia who have started to push in that direction. And it, you know, it helps when investors are asking for that as part of the information they're looking for, to sort of make sure companies understand it is relevant to us. It's relevant whether or not your retail workers, whether your workers in general are getting a living wage. We want to know that information, and we're asking.
That's an excellent point. So, and that was another topic I wanted to get to in terms of data. And so what I'm hearing from you all is that we need more data. As it's available, we're going to keep pushing for more data, and we should all be in on that fight and trying to encourage companies to make data available. And that as it's available, investors, asset managers like you all will incorporate that new information into your investment process. Is that a fair statement, summary of where we are with data? All right.
Perfect.
Thank you. All right, so we are just about at time. I want to give everyone an opportunity to give their final thoughts on a small topic, the future of social movements and investing. Yeah, I know, Matt, don't look at me like that. Just a brief closing thought for our audience.
I think a lot of social movements and investing thrive in adversity, because we see what we're interested in being threatened, and I would expect that to happen in the future.
Great thought, thank you.
I echo that and just say that during these times when, you know, it seems the darkest, it is the best time to really go deep and decide what's important to you, and time to put together your plan of action, because we will come to the light again. We just in darkness now.
Yeah, agreed. And I think the thing we need to remember is that we're working toward a you know, improvements in outcomes, and more equity and sustainability in the world, and sadly our work is not yet done. We have to roll up our sleeves and keep working harder. I've been at it now for 40 years in my career, and I do keep thinking, you know, it's like, it feels like we're moving at a very slow pace.
Well, I always hoped that we would be obsolete, you guys.
Right.
Not needed any longer because it was just status quo.
Right. We were
not there.
Yeah, no, Jamie, we were going to get to where that's just simply investing, because everyone will include all this. And that is, I remember having that conversation with Joan Bavaria, the founder, over 15 years ago. Well, 15, it was like 20 years ago, where she said, our objective is to work ourselves out of a job. Yes, but we are still very much needed today.
Yeah.
I think we can work ourselves out of the label. Let's not work ourselves out of a job.
Well, Julie, at this point, 40 years in, I'm trying to work my way out of a job.
I got it.
But thank you.
Nice try. So what I'm hearing is there's still a lot of work to do, despite the fact that we hoped that we would be further along at this stage. I think everybody, all of us on this panel are committed to that work, and we know plenty of others that are. And I've heard, as we were talking, a call to encourage investors to look for opportunities to bring their dollars into the space and support these efforts, which will only help get the data, get the changes in corporate environments that we hope to effectuate. And so I think with that, I think this is a great opportunity to close. Any other thoughts?
Thank you.
Thank you so much for
Yes,
your time
thank you.
today. Thank you to the audience for sticking with us and for the wonderful questions. We hope that you have some actionable insights to take with you leaving our session. Have a great day.
I want to thank you for that really fantastic session. for our attendees who are watching, we are taking a 6-minute break, and we will be back at 1:30 for our session on real estate investment strategies in the new administration. Thank you, guys. Welcome, everybody. Thank you for joining us this afternoon. My name is Paula De Laurentiis. I am the CEO of Equities.com, and I will be moderating this afternoon's panel, which is on real estate investment strategies in a new administration. So we're going to have a conversation going into an environment that has an anti-ESG sentiment, high interest rates that were intended to go down, but may not due to some of the new economic policies. And lastly, our president acknowledging that we have an affordable housing crisis and also willing to give tracts of federal land away. So with that, I'd like to introduce you to Sam Adams. He is the co-founder of Vert Asset Management. Sam, would you please share a little bit about yourself? And then I'll move on to David.
Yeah, thanks, Paul. Thanks for inviting me on to your program. It's really nice to speak with you today. I am, as Paul said, co-founder and chief investment officer of Vert Asset Management. We're a dedicated sustainable investment firm. I'm also the portfolio manager on our flagship fund, the Vert Global Sustainable Real Estate ETF. The strategy just passed its 7-year anniversary, and it invests in real estate investment trusts, or REITs, on a sustainability basis. Basically, we invest in the leaders in that field. And I'm also the co-author of Your Essential Guide to Sustainable Investing. If I can get it to show up in here. There you go. It's a book I wrote with Larry Swedroe to help financial advisors and investors understand the space of ESG, SRI, and impact investing better.
Awesome. David. David is the co-chief impact strategist at Community Capital Management. Welcome, David.
Thanks, Paula. Hi, Sam. Hi, everybody. I work for Community Capital Management. We're an independent impact investment management firm. We're 25 years old, so we've been doing this for a while. We invest in impact fixed income in the United States, affordable housing, affordable rental housing, sustainability, full product set that allows investors to work with us, align their mission and their values with parts of their fixed income holdings that we can manage on their behalf. A lot of our products are involved in helping to address issues like income inequality, sustainability, particularly affordable home ownership, and also affordable rental housing.
Well, thank you. Thank you guys for joining again. What I'd like to, before we get started, I'd love to really set the stage and talk about the real estate sector and defining it for this conversation. So I'm going to start with you, Sam. Can you give us a definition of what we are talking about in terms of real estate investment strategies as we move forward?
Yeah, so real estate's one of the biggest asset classes in the world, right? It covers a lot of different ground. And maybe the simplest way to split it up is between residential and commercial. Of course, with residential, there's single family homes. There's also apartment buildings or multifamily residential. You have manufactured and, mobile homes housing that's important actually in the United States as a source of affordable housing. And you also have senior housing facilities. You have dormitories for students. You even have prisons, right? So there's all kinds of different residential real estate. And then you also have the other side is the commercial side. And that's what we tend to invest in with the Vert Global Sustainable Real Estate ETF. That's all the REITs and the non-REIT holders of things like offices, of retail, which is, malls and shopping centers, hotels, resorts. You have the industrial sector, so that's all your factories and your warehouses. You have health care, you have storage, so that's both self-storage and then cold storage. And then you have the kind of the tech sector within real estate. Okay, so most of our data moves through or is stored in data centers. That's a big part of the real estate sector, a big part of the AI challenge these days. And actually our wireless infrastructure, like when we use our cell phones, right, or the internet like we're using now, it goes through towers or through different mechanisms that is often owned by real estate companies. So whatever business that you're in, right, you're using real estate at some level. And so I like to think of real estate as a supplier, as one of the main parts of the supply chain to all businesses, but it is also, of course, an important source of our housing.
Thank you.
And so Sam set it up great. If you think about all of those different types of real estate, that whole spectrum that he just described, there's some common characteristics. They all need a physical place. They all need some sort of zoning permission, and we probably are going to get to that in a little bit. And then there's construction cost that has to be financed, and then a lease up or a takeout period that follows. That's true whether it's a Class A office building or a shopping mall or any of the other things that you mentioned. Where our firm, Community Capital Management, comes in is we are the investors in the mortgages that are the takeout for not all of those categories that were just mentioned, but for the ones that relate to affordable home ownership or affordable rental housing, some of the green buildings and sustainable physical infrastructure work. All of those end up with a debt instrument that can be compared to a bond. It is a bond or a mortgage-backed security or an asset-backed security, but the ownership of that from an asset allocation point of view is in fixed income. And in our particular case, it's in high credit quality, taxable fixed income. So when you say real estate and you say investing, some people may think about a real estate fund that is, we would put in the alternatives bucket for asset allocation. And those funds could be doing anything from construction, rehab, repurposing, building, specializing in any of the categories that Sam just mentioned. But those properties, that real estate, when it gets permanent financing up to and including a 30-year mortgage, that gets done in the bond market, in the mortgage market subset of the bond market. And that's where we operate.
And I'll just add one thing to David's comments there. It's easy to actually characterize this. I'll be the equity guy and he'll be the fixed income guy. I'll be the commercial guy. He'll be the residential guy for the purposes of this discussion. But also it's important to understand that, human beings are one of the few species that really builds their own terrarium, if you will, right? Like we actually construct our society and we decide what it looks like and how we interact with it by building our buildings. And so it has a huge impact, not just on the environment, right? Buildings use 40% of the world's energy and create 33% of the world's greenhouse gases. But the way we interact with each other, the way that we commune with each other is really defined by the spaces that we build. So this is a very important part of our future, is how we decide what to do with our real estate.
So we're going to talk about, forward-looking policies and changes, but can you guys, Sam, can I start with you? What is the current state of the market in real estate?
Well, and the current state of the commercial real estate market is very healthy, and that's because the economy is strong. And so when the economy is doing well, right, vacancies are low and rents are high, much to the chagrin of people like me who rent, right? This is a good thing for real estate. Real estate does well when the economy is doing well. Of course, the flip side of that is the challenge of high interest rates. When you're trying to build more real estate, when you're trying to finance more real estate, that's where high interest rates give you some headwinds there.
Yeah, and I would just add, in terms of affordable housing or the cost of housing, which was a huge issue in the campaign for both candidates, that's something where there's going to be a lot of scrutiny. Used to be there were a handful of high-cost housing markets around the country. Now they're everywhere you look. not just East Coast, West Coast, and Florida, but all over the country. As Sam mentioned, they're very interest rate dependent. So there may be some stimulus programs, there may be some efforts to make that housing more affordable. But the crosswinds of other things, which I'm assuming we're going to talk about very soon, may swamp the benefit of potentially the Fed lowering rates, even as the bond market is worried about inflation and the impact of tariffs and the potential trade war.
So what current and existing regulations are impacting real estate today?
Well, I mean, David,
ahead.
I'll let you go. I'll let you start as a change.
Well, so it's very interesting. So zoning is local, right? So one of the things that seems to be the economists agree on and politicians can't agree on is what's the appropriate level of density in urban and suburban areas. And one way to put more people on the same amount of the earth is to build up. And that's something that is very contentious. Everybody's familiar with NIMBY. Unclear what change in the White House is going to do, to affect that. That's really region by region. There are some inclusive zoning movements around the country. They call it YIMBY, yes in my backyard. And there are communities that seem to have a consensus that they would like at least a little bit more density, but I would not say that's by any means the norm. At the federal level of where we may see changes, there are lots of regulations that affect housing, construction, OSHA, safety, Americans with disability, green building standards, financial regulation and consumer protection that affects the mortgage, the home mortgage market. All of those are currently in play for revision with consequences that I don't think any of us can really predict, but it would appear that they're going to lower certain aspects of the cost of new home construction.
Yeah, and at the federal level, there's a lot of tax that's controlled at the real estate space, in particular, things like 1035 exchanges or capital gains relief when you sell a property. As long as you buy another one in a certain amount of time, you don't have to pay tax on that. Of course, the same thing with your own home. And then, in particular, with regards to what we invest in real estate investment trusts, there's a tax-free situation there for the REIT at the corporate level. So REIT effectively are pass-through entities. They do not pay corporate income tax. They pay out dividends to investors, and the investors are taxed at that level. So unlike a C Corp, they're taxed once instead of twice.
So we mentioned, David, you mentioned earlier, green building standards. Do you expect that to change going into the new administration? Is they going to lessen those requirements? I'm curious what your thoughts are on that.
Again, none of us have the crystal balls that we like to think that we do, but I would imagine, given some of the rhetoric during the campaign, that there will be an effort to reduce those. HUD, the Housing and Urban Development Agency, Trump has not announced yet his pick for secretary there, but certainly there are plans that have been talked about reducing HUD's role in setting green building standards. Some of those now in some states, they're state regs. So whatever the federal government does, it's not going to affect what happens in California, New York, Massachusetts, Illinois. But the federal standards, as applied, I would say are probably in play. On the other hand, the Greenhouse Gas Reduction Fund and the Inflation Reduction Act, which were implemented and approved, and money has been appropriated, the effect that they're going to have, the ripple effect, the echo effect of them around greenhouse gas reduction in housing and affordable housing probably is going to be unstoppable. Just the way the calendar works.
Yeah, I think that you know, as when you put a real estate guy in the White House, you think that's going to be generally good for real estate, right? I mean, he's going to make sure he takes care of his own businesses and his friends' businesses. So I think you're going to see some deregulation that would be generally positive for business and thereby extension real estate. You'll see some probably tax policy that's seen as positive. He's talked about removing the SALT, the state and local tax cap, you know, on your mortgage deductions. And he's talked about scaling back the IRA. We'll wonder if he'll actually be able to do that. Most of the largesse of the IRA has gone to red states, and so he's already getting pushback from some senators and some representatives who want to keep those incentives in place. But you know, on the flip side, tariffs are generally quite negative for everyone, including the real estate business. It just raises costs for everyone. So that could be inflationary. That could keep interest rates higher for longer.
And I would add, you know, that there is an irony. The SALT cap was implemented in Trump's first administration, and he's campaigned for his second administration on getting rid of it, and that is, you know, again, for states with high state income tax and property tax, very expensive and does affect housing affordability. Sam mentioned tariffs. We're going to have to wait and see what happens, but you know, some industries are more sensitive to imported raw and finished materials, and some are less. The construction industry is very sensitive to that. And then also, you know, we have to take President-elect Trump at his word that he's going to increase the scale of deportations. And there you have a construction industry which is much more reliant on immigrant labor, let's put it that way, than some other industries. And so potentially, you know, two big things coming on the horizon: tariffs and deportations, that would make construction, all forms of construction, but including, you know, housing and affordable housing, more expensive.
And what about the sustainability component? Is that going to become more expensive, Sam?
Well, in most of the other than HUD and some of these federal programs, most of the green building incentives are state and local versus federal, right? So you have city level sustainability programs like Local Law 97 in New York City that says, you know, buildings have to decarbonize at a certain schedule or be fined. You have similar type of regulations in Chicago and San Francisco and Seattle. And then at the state level, you see that as well. So you're not going to probably see those change that much. There are some, you know, federal programs for individual homeowners to get their energy efficiency upgrades, a couple $1,000s in tax rebates and those types of things. We don't know what will happen with those. But you know, again, tax policy only has a certain amount of ability to drive things. We do annual engagement campaigns with all of our REITs. We speak to them every year, and we asked them last year a lot about the incentives of the IRA, the Inflation Reduction Act. And they said, listen, those are tax incentives for the most part, and so they don't affect REITs, right? Because REITs aren't taxed. And so they affect their suppliers and other tangential actors in real estate, but not particularly REITs. So I think on the sustainability side, it's going to be muted for the REIT space in terms of what the incentives are. To be honest, a lot of sustainability projects pencil out already, right? And so you don't really need too much incentives. They're always helpful, of course, to do a sustainability project. Innovations are driving more efficient things like HVAC systems and smart sensors. And there's just a lot of things you can do to an existing building to make it more energy efficient, to make it, you know, more resilient. And so a lot of those things are positive NPV projects already. Incentives are just, you know, the cherry on the cake, if you will.
Yeah, totally agree on rehab and green retrofitting. And then, you know, if you look at the commercial construction market, where we have visibility of that, we don't invest in it directly. real estate firms, landlords compete to have, you know, the highest grade of LEED certification for their buildings. That's not driven by regulation. That's driven by meeting tenant demand. You know, they're trying to lure tenants, and being in a green building is attractive to the people who make decisions about where to site their offices. Don't see that changing at all. You know, the demand, the support, the belief in climate change, the desire, the drive on the part of individuals and corporations to be part of the solution and not part of the problem is baked into our society, at least for a significant percentage of the population.
Yeah. I think it was in Jeff Gitterman's panel. They were talking about the demand drivers, in particular in AI and in data centers for renewable energies. You know, all of the big tech companies, Microsoft, Google, all those guys have net zero goals, right? They want to decarbonize by 2035 or 2040 or 2050. And something like 2/3 of Fortune Global 500 companies have net zero goals. And so those companies are not going to use data centers that aren't using renewable energies. They're not going to lease office spaces that aren't getting to them to their decarbonization goals. So that desire, that demand for LEED certified buildings, green buildings, clean, healthy buildings to put people in, rather than if they want them to not work from home all the time, is a huge demand driver that will continue to exist and persist beyond any administrative policies.
So when we're thinking about your investors in the REITs, have their sentiments changed? Are they like, where's their mindset in today's market with a new president?
Well, I think the mindset of the sustainable investor in general has changed, right? So in the first go around, when Trump was elected in 2016, a lot of people kind of jumped on the ESG bandwagon and said, I want to vote with my investor dollar because my Democratic vote didn't really work out in the way I wanted it to. But I think the ESG investor is a bit more sophisticated now, and they're aware of greenwashing. And they're aware of increased risks due to climate change as well. So they're looking for investment options that can help them achieve their sustainability goals, but also their financial goals. And the good news is they have more options than ever before. The question is, you know, that they've been raising for us most recently have been around climate change and the resiliency that real estate has to climate change, right? So if you have a storm, right, we can evacuate us, right? We can even move our businesses in some cases, but you can't move the building, right? So you have to make the buildings resilient to climate change, to storm, to wildfires, to flooding and those types of things. And so that's a big part of what's happening in investors' concerns now, is saying, not only can I make my building more resilient, but especially if they're in a state like California or Colorado or Florida, they've seen the exit of insurance companies from those markets for their own homes, right? And so they're starting to see that this climate change is having real financial impact, and they're starting to wonder about their own personal finances around that, but also their investment portfolios and how it's going to affect that.
How about you, David? Do you have any thoughts around that?
Well, so client interest, Sam's absolutely right. I mean, people are interested in using their money as part of their expression. The clients that we have family office clients, insurance companies, faith-based investors, high net worth, you know, some of the people I've seen on the call attendees, you know, financial advisors. The common theme for all of them is that they're trying to find a way to match some of what they believe in, or some of their support for a particular geography within the United States, with what they can do with their discretionary investment dollars and assets. That is not a political event. That does not blow hot and cold depending on who's in the White House. As I mentioned, we're 25 years old. I don't really have a count right now how many Democratic presidents and how many Republican presidents we've worked with. Probably pretty balanced, I think, if you add it up by by years. The difference you referenced at the top of this panel, Paula, the anti-ESG campaign of a year and 2 years ago feels like it's kind of run its course a little bit. I mean, there was so much pushback by investors who said this is a democratic society. You know, where is freedom of choice more visible and more personal than how you invest your money? And so I don't think anybody's saying that people should be obligated to make green investments or you know, racial equity investments or anything else like that. But by the same token, you know, how can you credibly say that someone who wants to do that, who feels that that's, you know, part of their mission or their mandate or their theory of change, whatever it happens to be, how can you say, well, no, that's not something that you should be allowed to do? And certainly, how can you do that from a legislative or regulatory point of view? So I think the clients are going to look at, like Sam said, you know, they're going to look at what do they have, if they have change that they'd like to see in the society, in the country, on the planet. They're going to use whatever tools they have. They're going to use tools as a consumer. They may be rethinking how they use their tools in the electoral process, and they may be rethinking how they lobby for regulatory reforms, but they're certainly not going to be rethinking how they make their investments.
Affordable housing was a big issue on the campaign trail, right? So it was discussed or on the news almost every day. And I'm curious, from an investor perspective, again, we talked about ESG, sustainability, green buildings. One of those ESG components, or about values-based, is affordable housing. And I'm curious, what is an investor sentiment today around affordable housing? And has that increased since it's become such a big discussion during the campaign?
Well, like everything else, there's a spectrum. So, you know, Fannie Mae, Freddie Mac, and Ginnie Mae all issue mortgage-backed securities in support of affordable housing of one sort or another, either affordable home ownership or affordable rental housing. The possibility, you never say never these days, but the possibility of a change in their status or impact seems very low. There are periodically calls for Fannie Mae and Freddie Mac to be privatized. That's probably something that's going to come up. It's come up before. You know, maybe this is the year that, or this is the administration where that happens. But if it's going to get through Congress, there's probably going to be some requirements that their mandate for affordability be maintained, even if they are taken out of government ownership where they are now. So that aspect of affordable housing is going to continue. Where there's such a concern and such a mismatch between supply and availability of affordable is in what you might call the market affordable. It's first-time home buyers, it's household formation, people who may, even if it's, you know, a married couple where they're both working, they may still have student debt, and they're in markets where their jobs are, and the cost of housing has gone up way ahead of the rate of inflation and way ahead of you know, the increases in income. And so you hear these stories all the time. That's not the traditional lament about housing affordability. You know, there's all kind of data about what it used to cost to get into a starter home in most markets in the country 25 years ago and what it costs now. And it's very expensive. Obviously, more supply would address that, but that supply has to come online in a way that's affordable for the people that you're trying to help and to serve. And one of the problems with having a real estate oriented president is he's focused on real estate from the supply perspective, and would appear that there'll be some successes there. But when that supply comes on market, for whom is it going to be affordable? And I don't think anybody, you know, knows the answer to that, because unless we see a big increase in income, in wages, or major tax incentives, you know, much more than was proposed by either campaign, The problem is still going to be there, is going to be, you know, structural for quite some time.
There's some positive outlooks potentially from the deregulatory standpoint there. You know, we were over mauled a while ago. We had too many malls, and we've seen a lot of creative owners who are sustainably minded converting those malls into mixed use properties, including residential. And a goal towards the 15-minute city, right? Being near the services that you need, and also living near the workplace that you have. And now we're starting to see that push on the office side. We have too much office space, right? So can we convert some of that office space into residential? Again, very difficult to do without some help around the zoning, around the help around the regulatory side. So there might be some opportunities there from the new administration to help out with that.
And that's an excellent point, and related point in terms of, you know, where is the government going to look to support housing? It's always worth mentioning that the biggest support for housing, there's political attention sometimes on subsidized housing, and, you know, how does that get tax credits, and, you know, is that appropriate use of taxpayer money? I think most people would argue it is, but, you know, the home mortgage deduction is effectively the largest subsidy for housing by far, in the hundreds of billions of dollars. And that goes to, Sam said he rents. I'm a homeowner. I use it, of course, but you know, that tends to go to higher income homeowners. For years, there was no cap. Now there is a cap. You know, one way that government policy could free up a lot of resources to focus more on housing affordability is to look at the home mortgage deduction. I would say the chances of that happening in the next 2 years are 0. But since we're having a public policy conversation, I thought it was worth mentioning.
Well, the other one is also writing off your state property taxes. So living outside of New York City, your real estate taxes are incredibly high. And that's no longer, you know, that could be an incentive too, right? Because no matter where you are in the, you know, in the ladder, if you're starting out and it's very difficult to purchase the home, then to maintain the home and pay those taxes, and then not having it as a write-off is you know, it's another challenge, another hurdle to overcome.
Yeah, and Sam mentioned the SALT, the state and local tax deduction. And, you know, I'll say it again, the first Trump administration put that in as a cap, and he campaigned on getting rid of it as a cap. But if you look at where that falls, there's an enormously large percentage of the population and the electorate that does not have state and local taxes above the current, I think it's $10,000 above that, you know, above that match. Now, I'll more to say that quite a few people who are listening to this call are above that. But again, is removing that going to help housing overall? I probably at the margins. Is it going to help housing affordability for non-traditional households, for first-time home buyers, you know, for people who've had to move because their job has moved? Not really. You know, and maybe at the margins, but not in a meaningful way.
Yeah, I would give the listeners some some incentives here that the main challenge around affordable housing is the lack of it, right? And that's because we have a supply shortfall in housing, right? We're missing, you know, several million units of housing in the United States that we need to build, and the main impediment to that is zoning, is the NIMBYs, right? We are refusing still to build up. I live in California, and it's kind of a circus here that, you know, that the California tries to put the incentive to build more locally, and then the very local places turn down those or find ways to keep that from happening in their backyard, and so us as citizens locally can do more around that than the feds can to change that kind of attitude and say, you know what, let me be in support of that 4-story multifamily apartment building going up near my neighborhood rather than trying to shut it down.
This was really very, very, very informative. And we've got a few more minutes. We only have one question right now, and I want to throw it out there right now because it's important for our listeners. This is for Sam. They're asking for your ticker symbol for your REIT.
That's my favorite question. VGSRX. So sorry, VGSR is the ETF one. Vert Global Sustainable Real Estate, VGSR. The X was when it was a mutual fund last year. Now it's an ETF. Same strategy, same everything.
There is another question here, and it's about insurance. And where do you see the insurance industry integrated into the real estate investments?
Well, I think that if you are a homeowner or you are thinking about moving at all, I think you need to factor in, and particularly the financial advisors that are on the call, this needs to be part of the advanced financial planning that you're doing for your clients in terms of retirement or their future planning. The need to self-insure your home is just going to go up all across the country. Insurers are going to continue to walk away from insuring things like wildfire and flooding and those types of things. So just be prepared for that conversation. Housing is going to get more expensive around that dimension for certain. If you can get insurance, it will also be more expensive. That's for sure. There needs to be some deregulation around that as well. But again, that would just increase prices. So that's going to be a continual problem. We can see a preview of that. Reinsurance rates have been going up dramatically over the last years. There's a lag. It hasn't hit the actual insurance market as quickly as it has reinsurance. So just be prepared for that eventuality. And then, I'm not saying this because I'm a renter and I have a problem with homeowners, David. I'm not, this is not a fight I want to get into, but you might want to think about the possibility of being a long-term renter, right? Depending on the changes in climate change. You don't exactly know whether you want to be golfing in Arizona 10 years from now, right? Or whether you want to be golfing in Florida 20 years from now, right? So those are just things to consider in your advanced financial planning conversations with clients, understanding that the way things are right now, both in terms of where you want to be and how much it's going to cost to be there, are not going to be the way they are 10 years from now.
I can't tell whether Sam is saying that because he's, concerned about my future, or he thinks I'm so old that I shouldn't be a homeowner anymore. But either way, it's a good point.
We have another question. Let me just check. Sorry, that was just a nice comment for the panelists. Before final thoughts, is there something that I missed? Would you like to just share your final thoughts, and then we can say goodbye to our session?
Well, I'll repeat something that I said before. When investors, when people don't get the results they want from their democratic vote, they turn to their shopping vote, their dollar vote, and their investor vote. And we'll probably see this again, just like we saw in 2016. I think the difference is now we've been through that hype cycle for ESG and impact investing, and then the anti-ESG backlash. And so the conversations are more mature, they're more understanding. And we actually didn't see the money run out the door like a lot of the news articles have claimed. And so I think the new investors that are coming on and looking at, they might be taking a look at this now, will see some very interesting things. They'll see funds that aren't greenwashing. They'll see funds that aren't underperforming. They'll see things that better fit for their investment portfolios. And an analogy I use with retail investors is, 2016, you're looking at an EV probably was a sacrifice of some sort in comparison to the gas vehicle that you had. Now that's no longer the case. For most car buyers, an EV is a better deal than a gas car now. And the same thing's happening with sustainable investing because we've got better sustainable investments now. And when you look underneath the hood of that, right, that is not contingent or dependent upon some administrative policy at the federal level. The reason is because sustainability just makes sense from a business perspective. And again, going back to the homeowners, you know, if you've changed the light bulb from an incandescent to CFL, you know, fluorescent, and then to LED, you understand this, right? There's a little bit of an upfront investment, but then you're saving money on the utility bill. And that's why we're just going to see more and more movements to sustainability in the real estate space, because it pencils out. It just makes financial sense to make these investments up front and then pay less going forward in terms of maintenance, in terms of energy costs, in terms of water costs, in terms of resiliency and recovery costs. So the sustainable investment movement is here to stay in the real estate space. And the Trump administration, it's kind of a mixed bag we're seeing in terms of some things that are going to help that and some things that are going to hurt that.
And I would just say, you know, if you look for a theme that sort of runs through a lot of the changes that we've talked about that are potential changes, all of which remain to be seen starting next year, a lot of them have in common, there's a thematic link of lowering costs for business generally. You know, we've been talking about real estate and housing, but it's been true, it's going to be true for other aspects of the corporate sector. The stock market loves that. Right? I mean, that's heroin for the stock market because I guess that's wrong. That's cocaine for the stock market. And so, you know, that's a boost to the bottom line. Now, you could argue if corporate costs are going down, the consumer should reap the benefits of that, not the corporation itself. That has not proven to be the case in instances like this. Those costs are going to be effectively, in many instances, outsourced, if you will, to society overall, to the consumer, including the homeowner and the potential homeowner. And then in terms of environmental regulations, you can expect that to be outsourced effectively to all of us and onto the planet. So that may all be terrible public policy. Everybody's entitled to their own opinions on that. But it creates an environment that is very, very strong for investing because it is just something that, you know, the animal spirits of our industry love to see. And it certainly would appear that, you know, their favorite show is coming on the air next January.
Well, thank you, gentlemen. This was very informative. I enjoyed our conversation. And based on our comments, I think others have enjoyed it as well. Thank you. Have a good afternoon.